It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Stocks closed lower Wednesday after the FOMC's big policy decision, but futures are rallying this morning. They are up right now for the Dow, more than 1%, the S&P 500, more than 1.5%, and the Nasdaq, the tech-heavy average, it's up more than 2%. The Fed cutting its benchmark lending rate by 50 basis points at its September meeting. Now, this is the first cut of this magnitude since the global financial crisis in 2008, excluding, of course, the emergency COVID cuts.
This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance.
And beyond the Fed, we're tracking policy decisions around the globe. The Bank of England voting 8-1 to hold rates steady, but leaving the door open to future cuts. BOE Governor Andrew Bailey saying that the bank should be able to cut rates, quote, gradually over time. The Bank of Japan is expected to hold interest rates steady at its meeting tomorrow.
And President Biden is expected to address the U.S.'s milestone interest rate cut today. He'll stop short of declaring victory, but discuss the significant progress made on inflation and outline the work ahead as we enter a new phase of the economy. Biden will speak from the Economic Club of Washington at 1:15 p.m. Eastern Time. Today's top story, a bold start to the Fed's easing cycle. The central bank surprised some on Wall Street by cutting interest rates 50 basis points Wednesday, marking its first rate cut in 4 years. Here with the takeaways from the Fed's monetary policy decision is our own Fed correspondent, Jennifer Schonberger. Jenna, it seems like some were shooketh, some were not. What do you make of this?
Yeah, Brad, frankly, I was one of those who was surprised that the Fed opted to cut by 50 basis points. But clearly, Fed Chair Powell said that the decision was rooted in confidence that inflation is falling back to 2% and a commitment to stave off further weakness in the job market. Couple of takeaways from here. First, the key is that Powell does not think the Fed is behind the curve. They actually view this as a proactive move to make sure the Fed does not fall behind. They're trying to preserve strength in the economy and the job market. And personally, I think this was the right move. I think it shows they wanted to catch up from July, even though Powell said that wasn't the case. He sort of went back, though, to say that had they had the July jobs report in hand during the July policy meeting, they may have cut. But they looked back at both July and August jobs report for this meeting. Secondly, the Fed started with a bang, but the path they laid out for the remainder of this year and next was much more gradual, with 2 smaller cuts this year and then just 4 next year. So far fewer than what the market was pricing in. And that makes sense, given that this economy is still showing strength and that the Fed has not declared victory over inflation yet. Guys?
All right, Jen, so we have this decision now. There was so much drama leading up to it. Now let's look ahead to what could happen at the next meeting in November. Lots of questions about what exactly the Fed is going to do, what metrics are going to be paying most, close attention to. What do you think?
Right. So if we look at the dot plot, we see that there are 2 25 basis point rate cuts that are implied for the remainder of the year. So I would expect them to cut by 25 basis points in November. For that to become more of a jumbo size 50 basis point rate cut, I think we would need to see greater deterioration in the job market between now and that November meeting.
All right, Jennifer Schonberger, great stuff yesterday. Great question there when you were in the room with the Fed chair. Jennifer, thanks so much.
Thanks so much.
The Federal Reserve kicking off its easing cycle with a half-point rate cut. Officials projecting they will lower interest rates by another half of a point before year-end. But Fed Chair Jay Powell making it clear in his remarks that officials aren't on a preset course and will continue to make decisions meeting by meeting. Here with us, we want to bring in Dennis Lockhart. He's the Federal Reserve Bank of Atlanta's former president. Dennis, it's great to have you here joining us this morning. So the market taking it, at least, they're not too worried about maybe what this 50 basis point cut could signal just in terms of higher risk of a recession. What's your take and your reaction to yesterday's decision?
I think it was, on balance, an optimistic message. It was not necessarily a reaction to anything particularly wrong. I think the committee is increasingly confident that inflation is under control. and they like where the labor market is, and they want to protect that. So it's really not a message of reaction to things going haywire. It's more to preserve a good thing.
You take us into what the conversations, what the thought process is typically like when you have this many committee members that are all in alignment and really just one dissenting vote.
Well, I think when the Fed pivots, it's certainly desirable to see pretty much a unified face, and they achieve that one dissenting vote from a governor, I'd point out, and that's somewhat unusual. Governors usually don't dissent. They usually go along with the chair. But nonetheless, the committee showed that everyone supported 50. I'm sure there were some who argued for 25 in the meeting, but everyone was comfortable with the 50 basis point move.
And Powell, during his press conference, really emphasizing the fact that this is a start of this recalibration process. So as we look ahead, what do you think, Dennis, that recalibration process more accurately looks like?
I think it will be a meeting-by-meeting judgment of what the economy needs, with some caution about the ability to react, perhaps with a deeper cut, if necessary, to some development that comes along. This morning's newspaper is, of course, talking about the potential for a longshoreman strike on the East Coast. That would be a mini shock to the economy if it lasted very long. So I think they will feel their way along, and there, as Chair Powell said, there is no preset path. Each meeting, they will decide what is the appropriate move.
So then, Dennis, when we talk about what's necessary, or I guess what the Fed would need to see in order to be comfortable with another 50-point basis move, you talk about the fact that we see some sort of shock. How would that then be reflected in the economy and the labor market, just in terms of the further deterioration maybe that would be necessary in order to justify another big move?
Well, I think the way that they're thinking about this is they want to preserve as much flexibility or optionality, is the word that's often used, as possible. They, I think, emphasize that the 50 basis point move yesterday was like a down payment. You could even argue it was a little bit of a catch up from what could have been done in July. So I think the base case should be 25 basis point moves, not 50, and no pause in the outlook at the moment.
We had an instant reaction from Rick Reeder of BlackRock, the chief investment officer of the Global Fixed Income Group. And he had mentioned that the key takeaway from the move was that it will resonate through the financial system for the coming months, is that the Federal Reserve will be lowering interest rates persistently for the next 2 years. What do you think continues to need to play out over those next 2 years for it to make sense for cutting to be taking place for that protracted an amount of time, and ultimately what that does for the targets that they should be setting, both for employment, and inflation?
Well, for that to play out without any pause, without any, let's just say, deviation from the mode of 25 basis points, or we're going to have to see the economy settle into a long-term equilibrium that justifies a march to the neutral rate, which round numbers I think is viewed as around 3%. So I think that's what Rick Reeder is talking about. And it could happen, but in my experience, there are always surprises. There are always things that come along that take you off of that course.
Certainly. During yesterday's press conference, Fed Chair Powell was asked about the health of the labor market, and just want to play this clip and get your reaction on the other side.
Wage increases, rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is. Quits have come back down to normal levels. I mean, that could go on and on. There are many, many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change, particularly over the last few months.
And so, Dennis, solid labor market, as you heard there, normalization, as we've heard from some of the economists we've had on. How would you really kind of describe or give characteristic to this labor market right now?
I think it's pretty healthy. Certainly, the unemployment rate is not at any level that is considered to be alarming in any way. It's a slowing labor market. I think what's happening is that hiring is slowing, but widespread firing is not developed, and the Fed intends to try to keep the overall growth level and overall health of the economy such that widespread firing does not happen. So it is a settling down of what was an overheated labor market a year or 2 years ago, coming out of the pandemic. And I think his characterization is accurate. It's really hard to look at this labor market and say that it's going haywire in some way.
Dennis, when it comes to the reaction that we've heard from down in D.C., we've heard from a number of Republican lawmakers, a number of Democratic lawmakers in response to this. Not too many that have been too critical as of yet, at least it seems like in those initial reactions. I'm curious how you think the committee is evaluating the political ramifications, or how you're viewing the potential here for political ramifications.
I think the committee almost totally ignores the politics around this. And I was in 80 meetings over 10 years. I can count on one hand the number of times anyone even raised a political consideration. It is simply not part of the process. And I think Chairman Powell has emphasized that over and over again. They just come to the meeting and decide what they think is the best policy stance for the economy, and that's it. It's just about the data and the economy. So there will be a lot of political noise around this because it's a few weeks ahead of the election, but it was not a consideration in the room, I'm most certain.
Dennis Lockhart, former Federal Reserve Bank of Atlanta president. Dennis, thanks so much for taking the time here with us this morning.
Thank you.
Certainly. Mm-hmm. U.S. futures rallying across the board this morning as traders digest the Fed's half-point rate cut. Or half percentage rate cut, we should say here. Stocks wavered for most of yesterday's session after the decision and ultimately ending the day lower here. Joining us now with a closer look, we've got markets and data editor Jared Blickery and senior markets reporter Inez Ferre. Jared, let's start with you. I mean, yes. my goodness, thank goodness it wasn't half a point, but but at the end of the day, I mean, what is most striking about this decision to you, and what could this signal going forward about the market?
All right, 50 basis points was kind of a big deal for me. I think 25 basis points sends one message and 50 sends another. The message I'm seeing with 50 basis points is we are a little bit concerned the data is weakening more quickly than we expected. And I think that's evident in the market's reaction yesterday, which was a bit tepid given the fact that this was a big momentous event that everybody's anticipating for years. There might have been some bullishness in the lead up to it. But let's go to the Wi-Fi Interactive. I have a couple of charts to share. And I think all of what happens with the market right now depends on whether or not we slip into recession. And it's probably too late for the Fed to backtrack and say, all right, we should have done this when. The wheels in motion are going forward. That's why we talk about these long and variable lags. So what we're seeing here is how stocks are reacting to rate cuts differently over time. And these are all averages. So this goes from 12 months before to 2 years after. And this cyan line right here is what happens to stocks when you have a recession. You can see that they go down and they go sideways for a long period of time after. When you have just a growth scare, that could be a minor credit shock. It could be the Japanese yen, for instance. Or if you see normalization, that's a soft landing, stocks tend to go up over time. So I see 50 basis points as a potential problem here. And I think the fact that we did see the first dissent from a Fed governor in a long time, 2005, I think that means something too.
It does mean something too, and we're seeing that get even more attention, I think, this morning, and as investors have had time to digest exactly maybe ultimately what this would signal here down the line. And I know you're closely watching the reaction that we're seeing play out in commodity space, specifically gold. What are we seeing there, maybe what that indicates?
Yeah, and it's interesting because Jared was mentioning whether we are going into a recession or not. And what we had seen in commodities, barring gold, barring silver, what we had seen in commodities is a downward trend signaling commodity deflation. And this chart really illustrates this. this. This is from Bloomberg Intelligence. This chart shows that these commodities, which are 23 commodities, including aluminum, copper, Brent, it's rare that you see commodities be in such a sharp downturn trajectory.
It's a big concern.
It is at the start of an easing cycle, or ahead of it even. So that's signaling that the Fed may be behind the curve here. When you do look at gold, we are seeing that gold has surged this year. This is a different story when it comes to commodities with gold. Gold, when you date back to 1989, gold typically has risen as the Fed starts lowering rates. Goldman Sachs has this chart out from a recent note. They're showing that ETFs backed by physical gold holdings rise gradually when the Fed policy rate starts coming down. So since gold is, these gold-backed ETFs are backed by physical gold, then they would be reducing the physical supply of gold, sending up the price of gold higher. So they're expecting gold to be going up to 2,700 in early 2027. And what could send it another leg higher are recessionary concerns.
Yeah, Jared, you said it's a big risk. I mean, typically we see in a cutting cycle some of the riskier parts of the market catching a bid from investors, but you say it's
commodities in deflation mode is a bad situation right now. You want the economies of the world to be thinking about the future, where we're renormalizing, where we don't have a recession, and so depressed commodity prices is exactly the opposite I would expect to see if in fact we're going to have a soft landing. Now, anything can happen here, and we're also in a seasonally very bearish part of the year. The last 2 weeks of September, very bearish. We get through this, we could be fine for the rest of the year, but I think the next couple of weeks are going to be fraught with a little bit of difficulty.
It'll be critical for investors to be paying close attention to. All right, Jared and Ness, great stuff. Thanks so much. Start of the easing cycle is yielding more gains for an already strong market. You're taking a look at futures up across the board. All three of the major averages on track to start the day in the green. You've got the Nasdaq futures leading the way. We're seeing a lot of that excitement play out within the tech sector. The Fed's aggressive 50 basis point cut. Now, comes after we got that news. The move is surprising markets as traders question whether or not the Fed is behind the curve a bit. Powell addressing those concerns yesterday afternoon.
We don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind.
The central bank is reigniting its rate-cutting cycle. Can the Fed pull off a soft landing? We want to bring in Kathy Bosch-Jancic as Nationwide, a chief economist and senior vice president. Kathy, it's great to have you here at the desk with us. Let's start with Powell's comments that we just heard, really reiterating the fact that they're confident that we are going to achieve a soft landing and avoid a recession. What do you think?
Well, happy to be with you. We hope that's the case, right? We want to root for the soft landing, and we hope that indeed cutting rates, as aggressively as they did underwrites that soft landing. And indeed, that's our own forecast. But there are real risks around that. Some of what was just discussed, you're seeing global growth, global commodities soften. And yes, the labor market right now looks to be in decent shape. However, we know that, that we've seen employment gains narrow, and we've seen a slowing in hiring that could be a precursor to much more deterioration in the labor market. Now, to his point, Chairman Powell's trying to get ahead of that, and great, but there's always the risk that they've been a little too slow in doing this.
And so with that in mind, now we're looking at a tapering type of scenario, a big cut out front and then potential tapering down to 25. And for how long those 25 basis point cuts get played out is anybody's guess. What is your estimation of how long in the duration of the cycle and when we might get some communication about even a terminal rate? It might be too early to talk about that.
No, great questions. And it's not too early because people are talking about that, and the markets are trying to, reach for that. Where will we actually, end in terms of the rate level? Our own forecast, actually, the Fed has come in line with our own forecast, and actually has come in line with the markets. But, our projection, just like the Fed, is based on mere theory, like getting back to a neutral rate. Over time, inflation continues to ease. But as Dennis Lockhart said, in reality, that doesn't usually play out that way. We get something unexpected. But, this is about, at the heart of it, it is about inflation slowing. And if it continues to ease, interest rates should be lowered in line with that. I look at the employment data, labor market data, as telling us how they really need to calibrate the size of those rate cuts. And do they go quicker because we do see this slowing in the labor market? That's not what the Fed is forecasting. Or do we continue to kind of cruise along, above 100,000 jobs each month? And then that means we're on path for a soft landing. But that's where I really look to the labor market data to give us, the direction there.
Kathy, if they were to go 50 again at the next meeting, talk to us about the risk that could then be associated with it if they were to go too far too quickly.
Yeah. So, they have to balance this, because if they go too quickly, you have a chance that you could reignite economic activity and inflation gets stuck above the 2% target. And that's something they really do want to avoid. And that would be the risk. But I think, if you look at the inflation data as we do, from the bottom up, we, like the Fed, have a lot of confidence that it is trending lower. And I don't see that big risk. I actually think the Federal Reserve should go 50 basis points to the next move. That's not our forecast, because we have to forecast what we think they'll do. But just like this meeting, they can show flexibility, and they're far from neutral. So cutting 50 basis points is not necessarily a sign the economy is falling apart. It just is a recognition that policy is just too restrictive.
And that's a great point too, maybe not being your forecast, but what you think they should do. And that's going to come up again for the committee to try and figure out, how do we continue to present a unified front so it's not one person dissenting and then everybody else saying, well, actually we should go ahead and do 50 again. So what is that conversation going to need to look like, and what's the tone that the Fed is going to need to strike in the interim period of time? Because we're going to get some meeting minutes. We'll see how this played out. Yeah. But that unified front that Dennis was talking about as well, that's going to need to be present at whatever the next decision is.
No, absolutely. Good point. And that's why we didn't necessarily think they were going to get 50, at least a few weeks ago, until we got these reports, kind of over the weekend from former Fed officials. We weren't sure that even if Chair Powell was leaning towards 50, that he could get a full consensus, especially the first rate move out of the gate. But I think you're right. To do another 50, you'd really have to have consensus. Maybe you could have 1, 2 dissenters. Once you get above that, that would indicate maybe, losing control of the committee, and that not everybody's on board. And that would be a bad message, really, for the Fed to send. So I think if they were going to go 50, it's a hurdle, and you would have to have, broad agreement. But I think the data will lead the Fed. And if, again, we get that softening in labor market data or consumer, that would then give enough cover for Fed officials to say, yes, let's move more quickly.
Kathy Bostjancic, who is the nationwide chief economist and senior vice president, thanks so much for joining us here in studio.
Thank you. My pleasure.
Thank you. Absolutely. Everyone, we're going to go to a quick break. We've got all your markets action on the other side. Stay tuned. You're watching The Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track some of today's best performers and worst performing stocks of the session. That will be found on Yahoo Finance's trending ticker page. Let's kick it off with Darden. Darden shares are rallying this morning. The owner of Olive Garden reaffirming its full-year outlook and is optimistic on improving sales trends. So you're looking at gains of 9%. Another big reason why we're looking at such optimism playing out within the stock this morning is actually because of new partnership here, Brad. Uber is partnering up with the Darden here that's adding some optimism. Darden planning to offer nationwide delivery for Olive Garden through a partnership here with Uber by May of next year. That's a pilot at a limited number of stores planned for late this year. They're hoping sales are going to improve off the back of that, so we will see whether or not that comes to fruition.
Yeah, I'm not sure if this means more or less of those parking spots that are allocated just for the to-go orders. But anyway, all these things considered, the quarter wasn't amazing here. You look at some of the same store sales figures, and ultimately that was a drag on the overall comps year over year here. Taking a look at the overall total sales, yeah, it was up 1% to $2.8 billion. But if you back out the 42 net new restaurants, that was essentially a miss. It was a decrease, 1.1% year over year for some of the same store restaurant sales here. Olive Garden down 2.9%. You had fine dining down 6%, and some of the other businesses down 1.8%. So all these things considered, you think back to what this consumer is navigating through right now and where some of the food away from home indexes for inflation are continuing to remain or be one of the contributors to inflation on a persistent basis. Food away from home actually rose in the most recent reading about 0.3% over the month here. So all these things considered, households are being a little bit more stringent and continuing to be discerning about where they are eating out or eating away from home, or we'll see if they kind of tap to order through Uber Eats in that partnership that you mentioned.
I would.
Yeah, why not? NVIDIA shares. That means you don't have to leave the home.
Exactly. It makes it even easier.
Yeah, keep your Netflix thing going, and you don't even have to click the button. Are you still watching? And yes. All right, let's talk a little bit about NVIDIA here this morning. NVIDIA rising, along with a number of chip stocks, including Broadcom. You've got ASML, you've got AMD, and Taiwan Semiconductor there on your screen. They're all higher. This is part of a larger rally off of the Fed's 50 basis point rate cut. We were discussing earlier what tech tends to do when the Fed begins or initiates or is in the midst of its cutting cycle. Tech tends to be one of the outperformers, and more largely there's a broader consideration about how artificial intelligence and artificial intelligence names will continue to be beneficiaries there. I've been looking through a couple notes over the course of this week. That still continues to be one of the plays that investors and investment strategists are leaning into as of right now. You also had NVIDIA and Jensen Huang making an appearance at T-Mobile's conference, too. New partnership there.
You did. And we actually had, I was doing the afternoon show yesterday, the Fed special, and we had a chance to speak with Dan Ives in reaction to the 50 basis point cut. And he was talking about the fact, to no surprise, I don't think this is going to surprise anyone who's a regular viewer of the program. He's very bullish on tech, and he's viewing rate cuts as a bullish sign here for the sector going forward, saying it's going to offer a significant bump to the upside. He was talking about the fact as to why everyone should be so excited about this next leg higher. A lot of that driven by AI advancements, namely NVIDIA being the dominant player there. No news really to anyone there. But when it comes to maybe some of that recent underperformance, when you take a look more broadly past NVIDIA, although NVIDIA might be a perfect example here, given some of that underperformance as of late. But the Philly Semiconductor Index, that has actually been off about 16% over the past 3 months. So you talk about the fact that maybe now if we do get a soft landing, if the Fed is in fact confident that we are going to be able to achieve that, then maybe we could see further movement to the upside here for some of these semis.
Yeah, UBS going into the FOMC two-day meeting said, without taking any single name views, we continue to like AI beneficiaries within the tech sector. Beyond technology, they see opportunities in quality companies with competitive market positions, resilient earnings streams, and exposure to structural growth drivers, such as the energy transition. Ooh. Wow, we've got a bell ringing, Shauna.
We do. We got a bell ringing here. You can see it playing out in Midtown and also downtown at the New York Stock Exchange. Lots of excitement from the confetti there from the Nasdaq. When you take a look at the major averages, we're right near record highs here at the open. Talking about the huge move to the upside. You've got the Dow Jones Industrial Average. Let's pull up the big number here, up just over 1%, shooting higher here, up over 500 points here at the open. You got the S&P 500 also moving to the upside, now above 5,700. We're waiting for the Nasdaq Composite, to open up here, and you can see gains of just about over 2% here at the open. And comparing that to the movement that we're seeing play out in the bond market, you're taking a look at yields actually moving to the upside now at 3.75, a bit unusual there. Taking a look inside the sector action, technology by far the leader. That's reflected as the Nasdaq is up over 2%. You got the XLK up nearly 3% here in early trading. Consumer discretionary among the top performers there, as well as the materials. Flipping it over, utilities, the only sector to open the trading day here in the red. And let's dig into the tech trade that seems to be working here at the open. Taking a look at some of those larger cap tech names. You got Apple, Microsoft, all up just about 2%, as well as Google and Amazon. Nvidia, we were just talking about the outperformance there. That's up about 4% here at the open. So certainly risk on sentiment seems to be playing out within the market. And we were just talking about the fact that we are seeing a lot more excitement surrounding some of those chip plays, and namely Nvidia leading that charge. But you've also got Taiwan Semiconductor. That stock up just about 4.5%. Broadcom, AMD, Qualcomm among the gainers here today. So again, lots of movement to the upside here across the screen. And taking a look inside the Dow, because why not? Look at a heck of a lot of green there as well. You've got some plays trading in the red, although not too many. Walmart, Verizon among the outliers there in terms of that downward movement. But again, in terms of the outperformance, a lot of that driven by those larger cap tech names. And then you also have a name like Home Depot here up just about 1.5%, Brad.
All right, thanks so much, Shauna. Let's get to Yahoo Finance's Jared Blickery for more in a look at what is moving here and a deeper dive here. Jared, what are you saying?
Well, let's start with the S&P 500, the kahuna, and I'm going to show you some candlesticks here, and this might be a new record here. We're seeing S&P up 1.61%, and there was a concern yesterday that we were selling off near these record highs, but this pretty much destroys that pattern. Now, you got to wait until the close. If we were to close within yesterday's range, that could be an issue, but so far things are looking fairly bullish. I just said a few minutes ago, 50 basis points has me a little bit concerned, but we are not seeing that concern reflected today in the markets. Now, here's the 10-year T-note yield. It is up about 7 basis points to 3.75%, and you can see this is over 3 months as well. The trend definitely down, but we are lifting off here. This is the opposite direction you would think when the Fed is cutting rates, but nevertheless, here we have the 10-year up a little bit, but we do see a widening of the yield curve. The Fed acts at the short end of the market, so we'll have to see where the long run ends up. Now, here we have the Dow, but I wanted to switch back to the sectors, just show you real quick that the mega cap sectors of tech and consumer discretionary really jumping right here. And here's the Nasdaq, where you see Nvidia up 4%, Apple up 2%, Microsoft 2.5%, Meta up 2% as well. So just looking really strong within the Nasdaq. And then finally, let's take a look at crypto, because I have seen Bitcoin jumping this morning up 5.5%, right back around 60,000. It's been seesawing around these levels for several months, but here we are, down about 5% over that time, 2 months.
All right, Jared, thanks so much for breaking that down for us here. Well, crypto-linked stocks, MicroStrategy, Coinbase, Riot, and Marathon all getting a boost after the Fed cut interest rates, and cryptocurrency also on the rise. Bitcoin hovering around 63,000. Jared was just touching on this, but again, when you look at that broad movement to the upside here, Brad, lots of questions about what exactly that upside could potentially look like. We were talking to a strategist, a close follower here of crypto earlier on in the week, and he was very optimistic, bullish. Some would say maybe not too realistic, just in terms of how high he sees Bitcoin potentially getting by year end and then beyond into 2025. I believe he said, regardless of even who is elected in the White House, he sees Bitcoin reaching, was it 200,000?
200,000 by the end
of 2025. So we're not saying that maybe is too realistic, but again, when you see this upward movement here, Bitcoin not necessarily a huge surprise given the trading and historically how Bitcoin is traded off the back of news like this.
Yeah, 200,000 by the end of 2025 is what I'm reading in that note that we had gotten earlier this week. Look, it comes back to what we were talking with Jared and Ines about a little bit earlier on, and what are some of the risk appetite type of trades that take place when you do see a cutting cycle start to initiate. That's probably why we are, and likely why we are seeing the move that we are seeing. You know, even me, I'm sitting here asking myself, wait a minute, we just made it through a Bitcoin halving. When's the next one? Because if we're going to kick off this cutting cycle, it's not too early to start thinking about when that next Bitcoin halving is. It seems like we're a ways off from that, and perhaps we'll be out of a cutting cycle by then. But March 26, 2028, that's the early best guess out there. So don't hold your breath on that one as of right now. But a lot to happen between now and then. I mean, we'll be squarely in the throes of another conversation around a general election by that point. But in this near-term period of time, more of the inclination to understand how each side of the aisle is going to rally around how there needs to either be regulation or clearance for crypto. That is going to be perhaps one of the larger catalysts that continues to move Bitcoin and cryptocurrency more largely at this juncture. Speaking of both sides of the aisle here, President Biden set to deliver remarks on the state of the economy following the Fed's rate cut announcement. We'll bring what to expect on Morning Brief. That's next. Note as well here. This is cool. Are you on the hunt for the hottest market commentary?
Time now for today's strategy session. U.S. stocks in the green following the Fed's big cut. But with equities hovering near record highs, has policy easing already been priced in? Joining us now, we want to bring in Peter Chur. He's a head of macro strategy at Academy Securities. Peter, let's start with the market's reaction to all this. Yesterday, we had moved to the downside. This morning, we're looking at gains across the board. Does this make sense to you, or is the market maybe getting a little too ahead of itself?
I think it's a little bit ahead of itself. How I've been kind of looking at this is I was expecting 50, and I thought the Fed would try and make it a hawkish 50. And you saw that attempt they had the dissent. They moved rates lower, the projection lower, but nowhere near to what the market was pricing at the end of 2025. And Powell's press conference wasn't super dovish. But I think the reality, and everyone just keeps staring, but they did cut 50. And I think that's giving a big impetus to the market. And we're going to see positioning play out. I think we settle down a little bit from here. Everyone can calm down. And then I actually think you want the rotation trade. I think you want value, you want small caps. And I think some of the AI and semiconductor problems we've been seeing resume rather than kind of extending this rally.
What's going to give you a little bit more conviction in that trade? Talking about the fact that it does have legs from here.
So I think data like this morning, we actually had good jobs claims, right? They came down a little bit. So I think people got a little bit too pessimistic on the jobs data. I've been arguing that how we do these seasonal adjustments has been wrong. We use a 5-year average and it has two problems. One is it includes the COVID shutdown and stuff, so we add too many jobs. And the other part has been that it really is based on geographic conditions that no longer exist, right? We used to add jobs in January, February, March because the Northeast would shut down construction, and we add them back and then we take them away in the summer. So many people have left the Northeast. The housing construction in particular is actually in the South where they have to shut down. So I think we get too optimistic jobs in the early part of winter, too weak in the late part of summer, and we're going to get a normal thing, and that's going to give everyone kind of this calm, like, okay, the Fed's not going to do much more, but the economy's fine. That really does well, I think, for the small caps and value stocks.
I'm going to create that checklist and pin it to my desk here, Peter, here on the day, and we'll check back in on that. But, you know, all these things considered, what you had just mentioned, the rotation trade, how much of that rotation trade also assumes and has a certain percentage of risk in that basket?
You know, there's some risk in it. What I think, though, when I look at it, you look at the P's, the valuations, the one thing, the last 2 to 3 years, maybe longer, seems everything's momentum, right? And AI became the momentum trade, mega caps have become the momentum trade. If we can get an extended rally, say, 2-3 weeks, we've already had 5 or 6 days, I think, in the Russell 2000, I think there's a chance that these become momentum. They're relatively small. I think there's very little liquidity in this market. There's very little true depth of liquidity. Money flows into the ETFs. You've got the day trading. So I think that will push things higher than they should. So I think you could get a really nice response from the Russell 2000 if it attracts the momentum cash.
Then on the flip side, let's talk about the bond market, the risk there. What do you see?
So I think we go back towards 4% on the 10s. So yes, the Fed's going to do a pretty good job of trying to control the front end, but I think you see a steeper yield curve, right? They don't care that much about inflation. I think as we now get past this Fed meeting, we can really start focusing on what's likely to happen in DC. I think it's largely gridlock, but even under gridlock, we're just going to keep growing the deficit. No one cares about the deficit. We have another debt ceiling issue. I think you'll see pressure on the long end of the yield curve with 10s, 3.90 to 4%. So a little bit higher. I don't think that derails much of the equity rally, but again, it will slow down those mega caps.
I mean, what does that set, though, for some of the policy that's also going to be impacting businesses? I mean, we think about the even energy policy or CHIPS Act and some of the dollars that have been put forward to really impact companies ranging from Tesla to NVIDIA and the entire SOX counterparts there.
Yeah, and that's where I'm really torn. What I would love to see is, I think the CHIPS Act was just a good first step. If we have this friction with China, and I do believe we have ongoing friction, it's going to be a battle about semiconductors, AI, sustainability. We need to support those industries. We need to get the foundries on board. We need to be making our own chips. So I think that money has to go, but it's going to be very expensive to build those. I think we need better strategies for getting to sustainable energy, including maybe more drilling in the meantime, more spending on traditional energy sources to get us over that hump. So I think we need some concerted policy. I think we get some of it, but again, if we do get some degree of gridlock, it won't be enough.
Peter, going back to what you just said a minute ago, when we talked about the bond market, the 3.90 to 4% is what you think that level is going to be. If we do push above 4% on the 10-year, is that when it becomes a bit more problematic for the equity
Yeah,
market?
I think as you start going above 4%, and what does scare me is if you go back to last fall, we went from about 4% to 5% on 10s, and it didn't matter what the economic news was on any given day. Right. Good news, bonds rallied a little bit, then sold off. Bad news, bonds sold off right from the start. And I am worried that we do see periods of like that. Too many people get long duration, people miss the trade, so they're now piling in here. And I think every once in a while, it just hammers home that no one in DC cares about the deficit. And as we get to this debt ceiling debate, you know what it's going to be. Everyone grabs, and both sides get more money to spend to kick the debt ceiling down the road. And that, I think, is what spooks the bond market. So I think there is a much bigger risk that we gap to 5% than that we get to 3.5%.
And so with that in mind, I mean, you were mentioning earlier, and this kind of ties into bonds as well. Are there other international bonds then that you would be looking for to kind of counterbalance that strategy?
You know, I think right now what you want to do is move into the 2 to 5 year sort of range on Treasury. So I don't think you want to be in money markets. Those are coming down. I think we've already had the good run in duration. So you give up a little bit in yield moving into that 2 to 5 year. Mm-hmm. If I'm right and we start backing up, those aren't going to back up as much, right? The real fear is going to be 10 year and 30 year. So I would definitely avoid like the long end or TLT as an ETF that people like. Mm-hmm. That's, I think, where the extreme is. So you want that 2 to 5 year. I like the US dollar. I like the US Treasuries better than other bond markets right now.
Peter Cher, who is the head of macro strategy at Academy Securities, thanks so much for taking the time here. I imagine our senior columnist, Rick Newman, whose ears are burning with some of the geopolitical conversations that we were just having as well. Speaking of that, whoa, wait,
I don't matter.
Wait, Rick, I'm going to bring you in a second here. All right, thanks so much, Peter.
Thanks very much.
Yes, well, later today, President Biden will deliver remarks on the state of the economy. There he is. Not President Biden, but Rick Newman. Following the Federal Reserve's 50 basis point rate cut, the Fed certainly in focus, but Biden going to use this address at the Economic Club of Washington to validate his economic vision, declare progress on the state of the economy. Joining us now for more.
Hi.
We've got Yahoo Finance's Rick Newman. All right, so
sorry,
what's the expectation?
front ran the introduction there.
It's okay. I got excited. I was ready to bring you in anyway here, Rick. So what are we expecting to hear at the Economic Club?
A bit of a humble brag, I think, from President Biden. It's going to be a version of what he's been saying for some time, but maybe he's going to be a little more forceful. I mean, Biden has, going back to the time when he was still the presidential candidate for the Democrats, he was going around saying, look, we've got a really strong economy, but we still have more work to do. That was his sort of two-tone message And the more work to do, of course, was get inflation down and get prices back to normal levels. So now he's going to say, look, because the Fed is cutting interest rates, that tells us that that validates that inflation is in fact down. That's like the sort of the official stamp of approval. Yeah. Now he's going to be trying to help Kamala Harris here a little bit. The problem is you can't just convince people that the economy is better than they feel like it is. And people do not like this economy. They have not for some time. Inflation has a searing effect on consumers. I think we forgot that because it's been 40 years since we went through a bout of inflation like we recently had. And it's just going to take time for people to feel like, the price of bacon or cereal or milk or whatever their personal barometer of the economy is, that they feel like it's back to normal.
Yeah, so Rick, is it almost just too little too late then? I guess when it comes to really influencing or helping maybe the Dems at this point, or what do you think Kamala's messaging?
It's a great question, and we are going to find out during the next, whatever it is, seven weeks at this point. If you're Kamala Harris, you'd certainly rather that the Fed is cutting rates than not cutting rates, and that the Fed is basically saying, okay, we're now comfortable with inflation. Don't forget about gasoline prices. That is the one price that people see the most, and they have come down. They're around $3.20 right now. We are probably going to have gasoline prices below $3 a gallon in half the country, maybe half the states by election day. So that is a good trend for Harris. Again, you'd rather have these things happening than not happening, but you also wish they would have started 6 months ago.
All right, Yahoo Finance's Rick Newman, as always, thanks so much for hopping on set with us. Keep right here on Yahoo Finance. Coming up, we're speaking to a strategist on how the Fed's rate cut is impacting the dollar and other central banks around the world. Stick with us. We'll be right back. The dollar paring back some of its losses here today. You're looking at gains of the dollar index up just about 0.4% after initially plunging yesterday following the Fed's larger than expected rate cut. Our next guest thinking that we may see some more weakness potentially here within the currency. So let's talk about that. We have Francesco Pasole, FX strategist with ING. Francesco, it's great to have you here. So talk to us about that upcoming weakness that it looks like you are expecting. I guess what does that downside then potentially look like?
Well, I think the initial reaction, to that big Fed cut was not very clear for markets. They tried to make sense of the fact that the Fed did cut by 50 basis points, but then Powell in the press conference was quite hawkish. Now, we think that moving on is more likely that the Fed will move in 25 basis point steps. However, within the markets will still prefer to err on the side of dovishness when it comes to pricing. And ultimately, they may prefer to stay on the soft side, on the bearish side of the dollar into the U.S. election, also because it appears that market pricing is moving closer and closer to favoring a win by Harris, who is a more dollar negative candidate.
And so with that in mind, as we're thinking about what this Fed move means, what does this signal to you for other central banks around the world?
Well, I think there has been a pretty substantial and clear decoupling between the Fed and other central banks. I think global developed market central banks, at least, seem to be moving much more in line. During the hiking cycle, the market rate expectations moved quite in line at the beginning of the easing cycle in some of them. But I think a lot of central bankers make clear that they are quite independent to the Fed. And I think that the decoupling is quite clear with the ECB and even more with the Bank of England. We saw today they're keeping rates at 5%, and they're not really signaling they're in any rush to cut rates. I'm not sure that we are in a position to derive much for other central banks based on what the Fed is doing.
That's so interesting because I have heard at least some of the commentary out there that this does pave the way, almost give the green light there to other central banks, but it doesn't sound like you necessarily agree with that or that it's going to be anything that substantially, I guess, plays into that decision.
Well, we must think of it this way. The Fed didn't move first. They're not particularly leading the way. This 50 basis point cut seemed, the way it was kind of described by Powell, it was more like backward-looking cut. They should have cut at the previous meeting, and they just decided to deliver 50 basis points. But then they went into a press conference trying to tell markets that 50 basis points won't be the norm. In a way, it feels more like the Fed is catching up with other central banks. You look at the Bank of Canada that moved early, obviously the European Central Bank, but also the Bank of England. So I don't think there is this very strong notion that the Fed is leading the way in monetary easing.
Okay, and so we're just months away from the U.S. presidential election. Can you tell us what might happen with the strength of the dollar here as we're considering both candidates?
Yeah, so I believe it will be very important, the positioning picture of the dollar once we get to the election. We think there is a decent case for dollar short positions to rise into the election on the back of these Fed cuts. And ultimately, this means that if we assume there's an equal kind of probability of Harris or Trump risks are more to the downside for the dollar because there would be more substantial negative, risks are more upside to the dollar because there would be an asymmetrically larger positive impact on the dollar if Trump wins compared to a win by Harris. We think it will be quite a binary event, but definitely if Trump wins, we'd probably be looking at higher volatility than under Harris.
Francesco Pasole, who is the ING FX strategist, thanks so much for taking the time here with us today. All right, we've got all your markets action straight ahead. Stay tuned. You're watching The Morning Brief. We're taking a closer look at Yahoo Finance's trending tickers. We've got three names to watch this morning. We've got Apple, Alibaba, and PayPal, and we're doing it in 30 seconds or less each. Now let's take a look at Apple. AAPL is the ticker symbol that's lighted up. It's up by about 3%, 2.9% to be exact there. They got a warning from the EU to open its iPhone operating system to rivals, allowing Apple products to be fully functional with other technologies or face fines under digital antitrust rules here. They said within this statement here that today is the first time that we use specification proceedings under the DMA to guide Apple towards effective compliance with interoperability obligations.
All right, let's switch over to Alibaba, the Chinese e-commerce giant, launching more than 100 open source AI models and text-to-video tools. This is substantial here. You can see the excitement on the street. The stock had been up just about 4%, now up about 3.5%. So once again, they're intensifying their efforts, trying their best they can to compete within the generative AI space. This open source model, it's more than 100. It's coming to Alibaba's Qwen 2.5 family. That's the latest foundational large language model that was released back in May. Many of the Chinese technology companies, like some of their US counterparts, they've been investing heavily within the generative AI space now for quite some time. So Alibaba here making its play, hoping it's going to help their business down the line.
And finally, let's talk a little PayPal here, teaming up with Amazon. Prime shoppers can now use PayPal to buy certain products here. Shares of PayPal moving up on this. You'll remember, of course, PayPal had hinged a lot of its business early days post spinoff from eBay on the partnership with eBay. And so now, as you're looking across where some of the opportunities have emerged for them to create more partnerships as some of the reliance has moved away from eBay here, PayPal looking to go straight to the largest online commerce platform in Amazon to make sure that they are able to offer this to Prime subscribers. I am not one of which, as of right now.
Still can't believe that.
Well documented.
You're missing out. All right, we'll keep right here on Yahoo Finance. Much more of your market action ahead. That's coming up next on Catalysts. We'll be right back.
A jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the trading day. The big catalyst for the markets today, that's the Fed's 50 basis point cut. We're going to break down the impact on housing, the broader market, and more specifically, what this means for the tech trade.
That's right. Let's start with that first big catalyst, the 50 basis point cut from the Fed. Officials anticipating another 50 basis points of rate cuts this year, but traders pricing in even more, up to 100 basis points of cuts by year end. Will the market continue to outdove the Fed, or will they get an alignment? We'll discuss.
Existing home sales missing expectations in August despite lower mortgage rates. Will rate cuts help spur more activity? What you need to know about the state of housing.
And tech stocks surging on the heels of that Fed decision. The Nasdaq still moving to the upside with Mag 7 names like Nvidia, Meta, and Microsoft leading that surge higher. Risk assets also outside of tech continuing to rally, including the likes of Bitcoin. Will the rally continue to last as we move further away from that critical Fed day? We'll discuss all of that next.
All right, Maddie, we got to start with the breaking news that we have out on housing. Existing home sales falling 2.5% in the month of August. That was well below the dip that 1.3% that economists have been expecting. So a weaker than expected print here. August existing home sales, the level was the lowest that we've seen since October of 2023. We take into account that it did fall 2.5% after rising 1.5% the prior month when we got that reading for July. For home prices, median home price, that rose just over 3%. That was up 3.1% from a year ago. The median home price just over $416,000 here. Maddie, one thing that does stick out to me within this report is inventory. The fact that that did rise here from a month ago and actually reaching the highest level that we've seen since October of 2020.
Yeah, and it's interesting to see the continued significant moves to the upside in the market. I think that's primarily driven by the reaction to the Fed moves, more so than any housing data. I do want to flip the boards over, just take a look at what we're seeing in the Treasury space, if we have that. Continuing to see a little bit of movement in Treasuries last time I checked to the upside here, just by about 5 basis points on the 5-year, moving up across the curve here. Interesting to see that continued movement to the upside, particularly as the market does digest that larger than anticipated rate cut from the Federal Reserve. But let's focus on the housing market. We've got our housing reporter, Danny Romero, here with us. Danny, let's first start with your reaction to this housing data that we just got in. What is the biggest sticking point to you?
Maddie, what a disappointment. Economists were really expecting sales activity to make a turnaround, especially that we've seen mortgage rates come down. But there are several factors for why we're seeing weaker sales activity. One, economists tell me that the high home prices, that's really keeping buyers to the sidelines. Buyers are also waiting for mortgage rates to fall even further, which could happen, especially now that we have finally gotten the Fed rate cut. Other potential buyers aren't really aware that rates are even lower than what they have been. Some agents are even reporting that many buyers are confused about the new playbook regarding agent fees and commissions following the NAR settlement. Others are even waiting after the election, Maddie. But Jay Powell yesterday, during his press conference, made comments regarding housing yesterday. So let's hear some of that commentary.
I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. If things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs.
This sounds like good news for potential buyers and sellers that rates could come down even further, given the fact if the economy evolves. But will that be enough to really incentivize current homeowners to sell? Just to give you some context, Fannie Mae says that as of June of this year, 80% of borrowers that have a 30-year fixed loan rate their rate is 100 basis points lower than what the current rate is at 6.2%. So affordability is still an issue here.
So what does this ultimately mean? Maybe, I guess the better angle might be then for home builders, right? Because they're almost the only game in town with so many people who are out there still looking for homes or want to buy homes. People who live in the existing homes are not moving from their homes. So I guess, is it going to be enough, do you think, to spur some of that activity or help boost the supply side?
It could, but it all goes back down to the local level, whether or not the zoning restrictions, right? That has been such a big problem when it comes to building homes. So it really falls down to the local level. And that was something that Jay Powell said yesterday during his press conference, that would be something that, he couldn't really influence at the end of the day. That really comes down to the local level and the local economy at that point, whether or not they will incentivize builders to build more. But we've even heard from Vice President Kamala Harris talk about how she's wanting to incentivize more construction of homes. So there could be some positive development there.
All right, Danny, great stuff. Thanks so much. Well, tech stocks are surging off the back of the Fed's decision to slash rates by 50 basis points. The Nasdaq leading all three major averages higher, up over 2% here in early trading. The stocks leading those gains, a lot of it's being led by the Mag 7 names, NVIDIA, Meta, Microsoft, Tesla, among the names soaring to the upside here today. So here at the Outlook for the tech trade, his reaction to the Fed's decision, we want to bring in Scott Kroner, and he is the head of U.S. equity strategy at Citi. Scott, it's great to have you. So it looks like the market, at least looking at this, the decision yesterday, some of Powell's commentary, saying that it makes a lot of sense to be a risk-on sort of sentiment right now. What do you think?
Well, Shauna, I think it's a buy the news, sell the news of reaction to the Fed. If you go back and step back and look at how we've gotten to where we are with the S&P thus far this quarter, the leadership this quarter has really been those areas of the market that are perceived beneficiaries of lower rates. So real estate, utilities, even the home builder ETFs have been hitting recent highs. In the meantime, tech is still lagging where it was last time the index was through 5,600. So I think essentially what you have here with given somewhat of a backup in, as you point out, in 2- and 10-year yields, is that a bit of a profit taking on the news in those areas that have been perceived as rate sensitive, and at the same time a catch-up move in that mega cap growth cohort that ultimately does benefit from lower interest rates, but has been a relative laggard thus far this quarter. All told, what you've got is an index moving higher. We'd argue it's more or less, near our fair value target, which is 5,600. So we'll have to watch how this goes. But I do think there's a tale of a couple of different markets underway today.
Well, let's talk about the tale for the Magnificent Seven. In reading your notes, Scott, I'm considering whether or not I'm going to start not saying that phrase moving forward as a markets anchor. You said to turn to a barbell approach, incorporating Mag 7 along with some other investment opportunities. Talk to me a little bit more about that.
So I think we've been saying for some time the Mag 7, I get it, it's a great description of this cohort of companies, but we've been arguing for the better part of this year that they're becoming more idiosyncratic in their behavior. Okay, so that's a starting point. What we're getting at is that when you look at some of the key leaders, and in particular NVIDIA on this, we get it. You've got three names that are 6% plus of the index: NVIDIA, Apple, Microsoft. Those companies are going to be important to index price action, and I think you're seeing that today. But what we're focused on from this barbell angle is we want to be holders of those. But when you look at the rate of increase in this and forward-year earnings expectations, it's been a stair-step function for over a year now. It's beginning to decelerate, though. Essentially, what we're arguing is that growth projections are strong, 40% for NVIDIA next year, 20% for the rest of the Mag 7. That's something that you have to recognize, appreciate, and respect, and that kind of augurs to we want to be holders of these names. But the lift in terms of getting a more material upside to projections from here needed to make these names still the serious outperformers. it's getting more difficult. In the meantime, as we go down cap into, let's call it mid-cap tech, if you will, we're finding a more attractive setup. Many companies that play to this broader AI implementation theme that have a less onerous implied growth expectation, still strong consensus earnings growth, and therefore we think the setup for a catch-up move, call it a broadening within tech, is a really important and interesting way to think about playing this broader trend going forward.
And Scott, as we talk about playing the broader trend going forward, I'm wondering if we could just take a step back for a second and think about, or maybe talk about what we heard from Powell yesterday, because he delivered this 50 basis point cut, but he did talk about the fact he remains very confident in the economy right now. He's a little bit worried about some of the weakness within the jobs market, but seemed like he was very confident that the U.S. was going to be able to avoid a recession. I'm curious, do you agree with his view, or are there some areas that you're seeing a little bit, I guess, a bit more risk than what Powell is pointing out?
I would say I mostly agree with his view. The way I think about it from a stock market perspective is I think we're in a transition phase, okay? You have to completely respect that we're at the end of a 2-year hawkish Fed narrative, and we're going down the path of something different. But this first 50 basis point cut, you can't call ease, really is becoming less restrictive, right? We're still in a fairly restrictive monetary mode, and I think Chairman Powell sort of expressed that. And so the transition phase that we're in here is that we have to allow that. Historically, when the Fed begins to ease, it's typically in response to some underlying economic concern. We've been calling it or referring to it as fraying around the edges. We don't think it dramatically impacts the S&P 500 aggregate index earnings performance, but we have to allow that as we go into the Q3 reporting period and then into the end of the year, there's probably a bit more downside risk to those more traditionally economic sensitive sides of parts of the market as to their fundamental trajectories. So we want to allow for a transition where we're going to have to be navigating still soft landing versus, gosh, there's still some lingering hard landing risk out there. But ultimately, this changing Fed landscape becoming less restrictive first, eventually more accommodative, we think sets up pretty well for earnings growth into 2025.
Scott, how are you thinking about positioning heading into the election prior to 2025?
Okay, so let's step back and think about the forces at work, and today's a great example. So we've been suggesting there are really 3 forces at work. Soft landing sentiment, plus or minus, is the incremental data going to support or not that the sentiment that we think is reflected in stock prices? AI growth trajectories and influence on that tech swath and other parts of the growth part of the market. And then over as a tail risk are the election effects. And the election effects are hard to position for because there's still a lot of wood to chop in terms of getting to the election. Essentially, a split Congress renders most of the policy platforms less effective, probably, and therefore less impactful on equities. We see sweeps as a bit more of a tail risk that we have to pay attention to. Our work is that both candidates' policy platforms, all told, are marginally equity negative, but it's still in this context of this bigger picture, where we are with the Fed in response to where we are with economic activity, ability to thread the economic, needle, if you will, to soft landing category, and then to the degree to which news flow continues to support that mega cap growth cohort. Lots of moving parts, but so we have elections at tail risk. The more important is to keep an eye on what we're seeing right now in terms of the Fed fundamentals, and do we get sufficient fundamental follow through on the Mag 7 to keep that cohort moving as well?
All right, Scott Cronin, we're going to have to leave it there. Amazing overview of all the parts of the market that we are looking at. Appreciate you joining us this morning.
Have a good day.
While equity markets continue to rally off of that rate cut, politicians on both sides of the aisle criticizing the Fed for the timing of the larger than anticipated cut. Former President Donald Trump indicating that the Fed must be seeing some broader weakness in the economy given the size of the cut. So here with more on the bifurcated view, we've got our very own Ben Werschel. Ben, thanks so much for joining us. So it sounds like, given some commentary we've gotten from senators in the past 24 hours, the left thinks the Fed took too long. The right is saying that this current administration pushed the economy into some weakness. Nobody seems happy here. What's up?
Right. I mean, the one person who could be happy about this is Powell. You know, if you're getting criticized from both sides, you're probably happy. He would never say that. But being attacked by Elizabeth Warren and Donald Trump is not a bad position to be in. On the Trump comment, as you mentioned, Trump's take this week, which is different. It's interestingly different than what he's been signaling most of the year, is that this shows that the economy is bad. This shows that Comblonomics, as he likes to say, isn't working, and the core reason for the cut is that the economy is faltering. Powell, obviously, as we've been talking about since the rate cut decision, and the last guest was talking about it, it takes a different tack. He started his press conference yesterday by saying the economy is strong. This is about maintaining labor market strength. So it's kind of the latest front in what's now a 6+ year back and forth between Trump and Fed Chair Powell, basically since then President Trump elevated Powell to this job, where the two kind of come at each other. But as I said, it's a different tack than we expected from Trump this week, who had signaled before he was going to go after Powell more personally after the central bank itself. He said in February any interest rate cut would be plain politics. So this is kind of a back and forth with Powell that Powell himself might be happier to kind of have the debate on, rather than whether the central bank is political.
And it's a great point there. Ben, always great to have your insight. Thanks so much for joining us here this morning. Ben Workshop.
Thanks, guys.
And in programming note, check out capital gains. More of Ben, Yahoo Finance, a look at how U.S. government policy is going to impact your bottom line long after the presidential elections have closed. Tune in to new episodes every Friday at 12 p.m. Eastern Time, wherever you get your podcasts. Keep right here on Yahoo Finance. Much more of your market action ahead. Again, just 50 minutes into the trading day, you're looking at a rally across the board. The Nasdaq Dow performing the three major averages as you see technology, the tech sector leading the gains. You got the Nasdaq up just about 2.5%. We'll be right back. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. You can find that on Yahoo Finance's trending ticker page. Let's start off with a look at DoorDash. Is moving to the upside right now, an upgrade from BTIG. They're rating it a buy. That's up from neutral. You're looking at gains of just over 3.5%. The firm seeing positive checks signaling near-term strength and commending the company's underappreciated long-term drivers. So let's talk about what some of those long-term drivers are going to be. This upgrade reflects several key themes that the team at BTIG pointed out. They talked about the fact that they calculated the TAM, the total addressable market across the restaurant and grocery delivery, at just around $1.5 trillion, less than 15% of that right now currently flowing through to the three leading platforms. So they're seeing some growth opportunity there. They also talk about the fact that Dash is positioned to ride the secular wave with a large user base that's going to give them, they think, the competitive advantage as they look to leverage to add new geographies. And then also just the benign competitive backdrop here in the U.S. restaurant delivery space. They say that Dash is able to both expand margins and also invest into those growth initiatives, all playing into that bullish call, Maddie.
Yeah, I think it's really interesting to point out the takeaway. I got a sense that they're basically saying this could be a consumer staple moving forward because people are just addicted to their food delivery. And so they say even if we're heading to a recession, they don't see downward movement, and they see this as a hedge against those more mature internet-first brands like e-travel, dating, and real estate. So a little bit of shade to some other sectors you might own there. All right, let's move over to a downgrade. We are looking at Five Below, trading down over 3%. This comes after JP Morgan shifted their rating for the discount retailer to underweight from neutral. They did boost their price target to $95 from $89. JP Morgan saying the retailer's third quarter comp sales through mid-September are down in the low single digits. And it's interesting because this comes on the heels of some field work that they did and conversations that they had with management as well. So this led into their kind of multi-year model from JP Morgan here. But coming in at underweight, they talked about the waterfall of math that points to Five Below lifting their contribution, decreasing in full year 2025 and further in full year 2026 as the overall comp base increases each year. So certainly interesting to watch given the challenges Five Below has been experiencing. You can see there on your screen year to date down over 54%.
Yeah, Maddie, in this note, they also talked about the potential pull forward here of Halloween seasonal sales, saying some people, that was cited by Michaels, people are planning ahead. Also the anniversary of proactive holiday sales helping pull forward year ago here, given the earlier receipts. So again, playing into the fact that maybe some of this has already been priced in, and that's why they're lowering their rating here of Five Below. All right, let's move on to Coursera. It's a stock that we're watching here this morning, moving to the upside. Bank of America initiating the coverage of the online education platform, $11 price target, a buy rating there. BofA citing an uptick in demand for new job skills and Coursera's ability to offer degrees and accreditation as a way to stand above or stand out compared to their competitors. You take a look at some of the reasons why they are a bit bullish here down the line. Now, this is a stock that, we're looking at a two-day chart here, so you can see the big spike here towards the end. But if you take a look at a longer-term chart, you can see kind of the volatility that we have seen within this name. And here we are today, still trading just above $8 a share. Compare that to levels that we were at almost a year ago. Here you can see the stock still off at just about 55%.
Yeah, the analyst Nafisa Gupta behind the call saying that Coursera is able to differentiate because they provide certifications and degrees by accredited institutions to their students. So it's not just the type of thing where you're taking a class and it's whatever, it's just for your own learning. There's actually a piece of paper that you get at the end of it. One quick thing I thought was super interesting, OpenAI just hired a former Coursera executive to grow their use of AI in schools. Obviously, OpenAI is still a private company, but that could be a potential headwind moving forward for Coursera as well. Well, coming up, we have a big interview to bring you. We've got the CEO of JetBlue, Joanna Garrity, on the company's turnaround plan. Stick around for that conversation and more right here on Catalysts.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Airline stocks posed for upside growth heading into year-end. That is according to Bank of America. Several airlines recently lifting their forward guidance, among them JetBlue. The airline citing decreased gas prices and increased July bookings as tailwinds. And this comes after a challenging year for the company involving a $2.75 billion debt sale. That led Moody's to cut the airline to junk. Charged with turning the company around, JetBlue's new CEO, Joanna Garrity, is joining us live at the Skift Global Forum. Joanna, thank you so much for being here. We really appreciate you taking the time for us. I know that you're 7 months into the role, but I want to talk about the challenges that the airline has had, specifically when it comes to capacity. I know you're planning on cutting capacity in the back end of this year, competitors ramping that up. How are you thinking about the path back to profitability from about 5 years ago while you're still scaling back some of the operations in the company?
Sure, thanks for having me. You know, we just launched our Jet Forward program, which has 4 pillars to success that we believe will get us well back on our path to profitability, focusing on reliable and caring service, best East Coast leisure network, products and perks customers love, and a secure financial future. We obviously have some capacity headwinds. We operate a number of our aircraft with Pratt & Whitney GTF engines, so that's definitely downward pressure on capacity over the next few years. But we're focused on really executing to our strategy and focusing on our inherent strengths to bring us back to profitability.
You mentioned the Pratt & Whitney engine, so I want to follow on the impact of that, the aircraft groundings due to those investigations. And these are some brand new planes. That's a huge challenge, I would imagine, for the company. What is the timeline looking like right now for recovery on that? And any update to any financial retribution that JetBlue is seeking from them?
Sure. So right now we have on average 11 aircraft on the ground. Next year that will rise to mid to high teens, and we expect, over the next few years for it to be somewhere around that number. We're working with Pratt & Whitney. They're an important business partner and an important part of JetBlue's future, and working with them to ensure that we receive the right level of compensation to reflect the impact that this is having to our forward-looking capacity.
Joanna, can you give us a better sense of what you're seeing from a demand standpoint? You've really hit the ground running since you've taken over as CEO. You talk about some of the headwinds, some of the challenges facing JetBlue. Obviously, it's not just JetBlue, but you take a look at a lot of your competitors, your rivals. They're up against those odds as well. Do you see that improving? And I guess talk to us about that timeline for further improvement.
Sure. So as you think about what we guided to about 2 weeks ago, some of that reflected the demand environment. Supply is obviously a bit elevated, but we have a large presence in the Latin region, and we saw capacity moderating there, which is important. It's still elevated, but we saw some, I think, positive improvements from that angle. And then obviously the fall trough is challenging. We've pulled nearly 10% capacity out of the fall trough. To try to help boost our performance. But the peaks and the troughs post-COVID are definitely much more acute, and we're taking a number of self-help measures to moderate some of that impact.
Since you mentioned LATAM, I do want to follow on that because there was a significant impact on the share price given some of the headwinds that you just mentioned on LATAM, which is one of your biggest revenue drivers. What is the single biggest thing that you did after that to change the path forward for demand coming out of LATAM?
Yeah, I mean, LATAM was largely associated with industry capacity ebbing and flowing, and it's a cyclical industry. And, as you look at where airlines put capacity, they'll rush to one area and then it'll moderate over time. And so we're focused on just ensuring that JetBlue's flying to the places where our brand is strong and where we make the most money and where it reflects the nature of the strategy that we're trying to execute to. We're very, very strong in the East Coast. We're doubling down on our East Coast leisure network. We've announced a number of new cities, IXIC, Manchester, New Hampshire, and then continuing to grow Boston, as well as some of the surrounding locations like Bradley and whatnot. And that's a core strength for JetBlue. LATAM is also a core strength. We're announcing a number of new markets opening up there as we go into 2025. And, as we hope capacity appears to be moderating, and that hopefully that trend continues, but it remains a stronghold for JetBlue and a very important part of our network.
Joanna, as we take a step back, I want to talk about the presence of activist investors, specifically Carl Icahn, the pressure he's put on JetBlue now having 2 board seats. I'm curious, just while you've been at the helm, the ability, how you've navigated that, what exactly that has done inside the company, and I guess ultimately the ability to come to some sort of agreement to get everyone on the same page in order to foster that type of growth that you've been talking about.
I think it's great when you're aligned with your activist shareholder and board members. JetBlue is undervalued, and we strongly believe that. We've got a number of really important strengths, whether it's the slots, the gates, our network, our people, our product offering, and we want to make sure that we're getting more value out of that. And so we launched our Jet Forward program with the support of our entire board, including the 2 individuals who came through Carl Icahn's group. And we're focused on transparency and making sure that everybody's on the same page. It's a great company, a great brand, great people, and we need to turn things around, and everybody's aligned from that perspective.
And Joanna, following on that, I've heard you talk about the importance of fostering a no retribution culture, particularly when it comes to maintenance checks. I'm curious, I know that JetBlue previously had the most efficient maintenance group in the entire industry, and that has changed. But also we are in an environment right now where if you think about the issues that we've had with the likes of Boeing, safety, of course, comes first. How are you weighing the challenge of holding those 2 needs for the company at the same time as the CEO?
Safety is always the number 1 priority for JetBlue. It's our first value, and it's something that we don't compromise. We have a culture where crew members can come forward and report things. It's a non-retribution culture, as you pointed out, and it's very important that our team feels that truly to their core. The moment that you have a culture where people feel that they can't come forward and disclose things is where I think things start to take a turn in a direction that's not so great. If you don't have a safe airline, a safe manufacturing facility, then the brand, the experience, none of that really matters. And we spend a lot of time focusing on how to do that. In terms of efficiency, post-COVID, people are less experienced. And when they're less experienced, it requires you to do different things like add more staffing, enhance training, look at different tools that can support them. And we're very focused on doing all of those things.
Joanna, I also want to quickly ask you about potential M&A in the pipeline, given the news and everything we've seen, the developments surrounding JetBlue's merger agreement or lack thereof, the termination of it with Spirit. I guess, what's your view on the regulatory landscape? And do you think a sizable merger down the road could be something that would make sense at some point again for JetBlue?
Yeah, we're focused on our organic strategy, and we've had a couple of years of just challenging things, and we need to focus on bringing JetBlue back to the brand and the experience that customers know and love. In terms of future M&A activity, clearly this administration is far more challenging. JetBlue is trying to grow to be a 9% player in a world where you had 3 carriers that were, call it 20% each of the domestic seats in the United States, and that didn't happen. So we're moving past that. We're focusing on reminding customers about what makes JetBlue special. We need to be profitable. We want to be loved. And we're going to continue to double down on that and focus on our strengths.
So you wouldn't pursue Spirit again?
We're not pursuing Spirit again.
All right, Joanna Garrity, it's great to have you. Thank you so much for taking the time to join us here in Yahoo Finance. We really appreciate it. We know you have a very busy schedule. CEO of JetBlue, Joanna Garrity, thanks so much.
Thank you.
Coming up, what does the Fed's 50-point cut mean for the bond market? We're seeing the reaction play out in yields here this morning. We've got more on that when we come back.
Treasuries edging higher today following the Fed's 50 basis point cut and signals of more cuts to come. But our next guest says the bond market is pushing the narrative just a bit too much. For more on this, we welcome in Greg Peters, PGIM's Fixed Income Co-Chief Investment Officer. Greg, it's great to speak with you. Thank you so much. So I'm curious about this idea that the bond market is overreacting to the Fed. Why do you think that?
Well, there's been such a large move leading into this meeting, right? So the two-year note has rallied 150 basis points just in 2 months. And so it's just a little too much too soon. And I think you're seeing that in the reaction today where the bond market's taking a breather because what's built into the current pricing is just a continuation of a lot of cuts, over 150 or so. And to me and to others, I think that actually has to be more of a tipping into a recession type of an environment, not a soft landing. So I think it's just a little too much too soon, honestly.
So then, Greg, what do you think, I guess, is more realistic? Are you in the camp more in line with what the Fed has actually forecasted, or what are you expecting? What's baked into your projections for future cuts?
Yeah, so I think there has been a revisitation by the Fed in terms of their future forecasts. I think that's much more in line with our thinking. What's interesting from a market standpoint is that it always pushes and pushes and pushes. And so there's a continued repricing. And when the Fed reprices, the market pushes even more. And so, I think the Fed projections are very much in line with our thinking. And I think they'll be rationalized over the next several months or quarters.
Can we talk about what Treasuries look like after that rationalization starts to kick in 6 months from now, when we've all emotionally recovered from the past 24 hours? What are we going to see in yields?
Yeah, so I think yields are still poised to come down a touch, not a lot. We've seen a big move already. It's highly dependent upon the economy, of course. So a soft landing, I think we're priced appropriately. But I guess the excitement around fixed income is the hedge component of it, right? And so if we do actually tip into a recession or an economic slowdown, then Treasuries fixed income provides a tremendous offset to your portfolio. So I think that's the value of fixed income. Yields are higher. I think it's attractive, and you have that protective quality to it that you didn't see before when base rates were so low. So I expect continued enthusiasm around fixed income for the high yields and the fact that it does protect you.
Greg, when you talk about gaining some of that protection, I think a lot of investors are trying to figure out what exactly, investors are trying to figure out everything almost at this point. But when it comes to the bond market, just what exactly the path ahead looks like, especially for the yields. When you take a look at the 10-year yield, for example, we were talking to a strategist earlier in the program, and he was saying he expected to be in the range of 3.9 to 4%. And if we're within that, he thinks that a lot of what is already largely baked in and has already been priced in, it's not really going to move the equity market too much. I'm curious, do you think the risk that we could push above that 4% level in the 10-year?
I think the risk is only if inflation picks up. And so I think one of the black swan events for 2025 is with the economy looking to be okay, Fed being more accommodative. Does that create more inflation again? And the markets aren't really prepared for that. So it's not a base case, but that is the environment where I see yield moving higher. So absent that, I think we're in a pretty kind of range bound and if anything, a bias to lower yields, not higher yields here.
All right, Greg Peters, we appreciate you taking the time joining us here this morning. Thanks so much for your insight. PGIM's Fixed Income Co-Chief Investment Officer. Thanks so much.
Thank you.
Coming up, Yahoo Finance Executive Editor Brian Sozzi. He's speaking with the CEO of T-Mobile, Mike Sievert. That's coming up next.
T-Mobile is already looking out into the year 2027. Big investor day, closely watched on the company here. Let's bring in T-Mobile CEO Mike Sievert. Mike, good to see you. I'll say fresh off the stage. I mean, coming out of the block here, you expect to add $10 billion in adjusted operating cash flow between now and 2027, or I'm sorry, I should say adjusted EBITDA from now until 2027. How do you get there? I mean, that's a big number.
It is. You know, first of all, by being the growth leader. I mean, look, this engine that drives our growth is now proven. When we did our Capital Markets Day 3.5 years ago and said we would penetrate smaller markets in rural areas and get after enterprise and convince people we have the best network, there was no proof. But now we've got momentum on our side years later. You know, our most recent quarter, Q2, was the biggest Q2 ever in our history on postpaid phone net additions. And so it gives you an example that momentum's on our side because our formula is working. And so we've extrapolated what that business will deliver along with big transformations in the customer experience, which makes our business more efficient over time. Take it all together along with the network leadership that will only be further extended. And we see our way to $10 billion additional EBITDA at the high end of our guidance for 2027 versus last year.
I still remember that investor day in 2020. It feels like yesterday, but if you had to look back, I mean, how is T-Mobile different? How have you differentiated the company in the past 4 years? And what's the one thing that you think will be key to your growth over the next few years?
Network is the essential fuel of this industry. And when we made our bet back in the teens that the 5G revolution would unfold in mid-band on smartphones, not in millimeter wave on new gadgets and every other thing the industry tried to convince people of, it turns out we were right. And we were able to use the merger with Sprint to leapfrog everyone from dead last in the 4G LTE era to first and best in the 5G era. We have the best 5G network in the world and the most advanced one. And that's because we called the ball correctly. And now, you know, the good news is most Americans still don't know it. Our network satisfaction and reputation is now right on par with the other guys, but it doesn't represent the superiority that the actual network does. So on reputation and brand, we've got lots of room to run.
Why do you think you needed to have this investor day now? Did you think the street was getting a little concerned that, hey, look, T-Mobile can't keep coming out here and beating on earnings every single quarter, and they can't keep doing what they have done since the last investor day?
No, it's just that the essential work from last time's complete. You know, we said we would combine these two companies and complete the most successful merger of scaled telecoms in the history of the industry. And we did that. And we unlocked the value in excess of what we promised. And now it's time for the next chapter. And, you know, we've actually been quietly working on this for almost 2 years, laying the foundation for how we will use AI and data in our new IT architectures to create a bespoke experience for every customer in the future. And today we wanted to unveil those plans because investors want to know, after that historically successful run of the last few years, what's next?
Yeah, I want to get into what you did with OpenAI too as well. But before we do that, you've turned into the acquisitive CEO. Now, back in that other investor day, I think a lot of folks didn't expect after the Sprint deal integration, you're not going to go out there and spend billions of dollars to acquire companies, but you have been out there. You have made some big plays. I mean, how are these acquisitions going to change the company, and why are you making these bets?
Well, the ones that are pending are US Cellular, Metronet, and Lumos. And each of them has a different story, but US Cellular just fits with our overall portfolio fantastically. The company's always been great at smaller markets in rural areas, and that's a big growth strategy for us. And so it's just very, very complementary. In many ways, just like Sprint was, but on a much smaller scale. And then Metronet and Lumos are about us stepping in to become an owner in the fiber space and to create a national T-Fiber brand that will augment our 5G broadband, which is by far the fastest growing broadband product in the industry.
And what exactly have you inked with OpenAI? I mean, will that change the customer service experience? So I call up T-Mobile, maybe I'm talking to a bot, but a really smart one that might help me get off the phone a lot quicker.
Well, it's multivariant, but that's one of the pieces. Our job is to figure out first and foremost, how do we prevent the need for you to call us in the first place? Every time you finally have to call us, something's gone wrong. We haven't predicted your intentions correctly. And so Intent CX, which is the model we're creating with OpenAI, is all about using the vast amount of data at our fingertips to curate an experience for you at T-Mobile that makes your experience successful, so you don't have problems in the first place. And then once a problem arises, that we solve it as quickly as possible and as completely as possible, using real-time data at our fingertips in a way that humans couldn't do without this AI added on. Maybe the AIs will be interacting directly with people, probably will, but they'll also be helping to make our agents be able to give their service to customers using AI superpowers to make them smarter and better.
Do you think we're nearing the day or the point, Mike, where me getting a human on the phone to help me with my bill are nearing an end?
No. In fact, what we forecasted today is that there will be about a 75% reduction in calls offered to our human agents at our stores and in our care centers. But those remaining 25% will be some of the gnarliest ones. And so it will require a higher level of expertise, more experienced and seasoned people, probably completely onshore and domestic and full T-Mobile employees to be able to solve those problems. And so what it results in is a better job. Right? Today, the job's transactional. You call us and care because we have access to a computer you don't have access to. This era of AI and Intent CX will be able to eliminate that. What now you'll be calling for is because we're good at this. We have knowledge and experience because we do this all day, and you might do it, say, an upgrade to a phone every couple of years, and we got your back.
There's been some reports that the new iPhone has been mixed with meh. I mean, it's been met with meh type of demand. What are you seeing out there? And you think we'll still get that big super cycle with the iPhone 16 if the Apple intelligence is not going to be all in there on this phone off the jump?
Well, what it might mean is that the demand cycle will be a little bit more stretched out as word of mouth builds after people actually get the AI features later. But already our sales are higher than last year. Last year was a good year, good iPhone launch. This year they're higher. We're seeing preference for the Pro versus the regular edition. We're seeing preference for the max sizes. So people are engaged and interested, as they always are, in what's next. And we're seeing so far so good.
And lastly, Mike, I have to ask you this because you did study economics at the University of Penn. I mean, this is a big day for the Federal Reserve. They surprised the masses, 50 basis point rate cut. As the CEO of T-Mobile, how does a rate cut like that help your business? Does it lower your financing costs? Are you more inclined to maybe go out and buy another fiber optic business? I mean, this has to be a big deal for a lot of CEOs.
Well, first and foremost, the government, the Fed included, is all about making sure our economy is vibrant, not just for the short term, but for the long term. And that's important for T-Mobile, and for every company that serves consumers. We need to make sure that the consumer economy continues at, a great pace, doesn't get overheated, doesn't fall into recession. And so, we appreciate that. Now, I will say that T-Mobile's model is more resilient, in my opinion, to changes that might happen in the macroeconomic circumstances than perhaps our benchmark competitors. We have a long expertise at dealing with customers that have variable and sometimes difficult economic circumstances. And we have the best portfolio of brands positioned around value, which, if there's a change in the economy, will become only more important. But in this vibrant economy, generally speaking, correcting for inflation that's been difficult the last couple of years, our business is just on fire, and we're realizing some of the best growth in our history.
Mike, last, let me just quickly follow up on that. I mean, do you see the consumer in a place that they need a 50 basis point rate cut? Are they trading down from certain T-Mobile plans to more Mint Mobile, where it's more affordable?
Not so far. In fact, people have been trading up at T-Mobile. And so again, and it's one of the things about our category that makes it different than some. I'm not the best CEO to be a canary in the coal mine on the economy because our customers will stick with us. This is an essential category. They will make sure that mobile phone bill gets paid, along with their rent. And so we don't see the early signs of softening. Our bad debt remains, right around pre-pandemic levels, really good levels. By the way, better than any of our benchmark competitors. So T-Mobile customers are the best payers, and they value this mobile service that they get from us.
Mike Sievert, always good to catch up with you, and I'm sure we'll be continuing to follow your story through 2027 and beyond. Mike Sievert,
great to see you.
Talk to you soon.
All right, our thanks to Mike Sievert, CEO of T-Mobile, and of course our thanks to executive editor Brian Sozzi for bringing us that conversation as well.
All right, well, coming up, you've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. The Fed cut rates by 0.5%. Now what? Well, on today's show, we're going to bring you the personal finance playbook for what the cut means for you and your money. Got some savings and money in an account here? Well, guess what? We're going to break down how your rate might get a little bit slimmer thanks to cuts. And we're exploring how it might be time to revisit your portfolio allocations. And then we're covering all things housing, breaking down how mortgage rates are moving off of the back of cuts. And if you're not in the market for a new home, maybe it's time to refinance that home that you bought when rates were higher. And then we'll be discussing how your credit card and consumer lending will be impacted. All that and much more coming up on this episode. But first, let's take a look at some of the market action. We are 90 minutes into the trading session after all. Stocks right now rallying after the Fed cut rates by 50 basis points and signaled more easing to come this year. While the cut brings down borrowing costs, it also means that we'll earn less on some of those savings. So what should people do? Yahoo Finance personal finance editor Molly Moorhead is here to explain. Hey, Molly.
Hi, Brad.
I want to tell you about three good options right now. Of course, this rate cut means that we're going to be earning less interest on our savings, but there's still good options. And so, a high yield savings account is still a really good place to put your money. It's liquid, it's accessible, and you'll earn a little interest every month. And then the kind of tried and true investment products of CDs and treasuries are very low risk. In the case of treasuries, there's no risk, and you'll earn a fixed rate of return on your money. Again, it's going to be lower than it's been the last couple of years, but still, paying a little bit of interest every month.
And so, is there an urgency to lock in rates right now?
Yeah, that's an important point because the Fed cut by 0.5 point yesterday, and the market anticipates 2 more cuts this year. And so with a high yield savings account, that interest rate floats, and it can go up and down depending on what the Fed does. But if you buy a CD today or you buy a treasury today, you are locking in that rate. And so they're probably better now than they will be 2, 3, 4 months from now. So it's a good time to lock them in.
All right, Molly Moorhead, Yahoo Finance, personal finance editor. Thanks so much for teeing up this next conversation as well for us, Molly. Appreciate it.
Thanks, Brad.
Absolutely. Well, the Fed's 50 basis point cut yesterday provides an opportunity for investors to reassess their current portfolio allocation. So what strategies should you be using to take advantage of the Fed's easing cycle? Here to help, we've got Matt Stuckey, who is the Northwestern Mutual Wealth Management Chief Portfolio Manager of Equities. Matt, great to see you. Thanks so much for hopping on the program with us. So, Fed cuts rates by 50 basis points. What are some of the pivots that people would be apt to have in mind, perhaps going into the decision, but now that we've got a little bit more of the conversation, or at least the pathway forward, coming off of the conference that took place yesterday after the decision was made?
Well, good morning. I think now is a really good time to revisit your financial plan, goals, and objectives with an advisor. Over the last year or so, a lot of investors have flocked to money market funds. And earlier this month, we saw a report that about $6.3 trillion is sitting in the money market asset class right now. What happened yesterday with the Fed starting their easing cycle with a 50 basis point cut is that the attractiveness of money market funds has started to dissipate somewhat. And if the forward curve comes to fruition, if we're having this conversation a year from now, Brad, instead of earning 5.5% on your cash, which is where we were, just last week, that number's down to 3%. So there's some changing return profiles happening in the capital markets, and an advisor can start to help you migrate some of that cash into a diversified portfolio. And that's really important because if you look over a longer term horizon, 5 years, 10 years, the one asset class that tends to be towards the bottom of the return stack is cash. So sitting on excess cash does have risk.
And so with that in mind, as you're thinking of the diversified mix of a portfolio, how drastically do the percentage allocations, do you think, change post-decision as well, whereas someone might have been looking at fixed income and their balance of equities versus fixed income, perhaps they even have some crypto, how all of these things might shift because of the decision from the Fed and the pathway forward here?
I don't think your long-term strategic asset allocation should be changing very much based on yesterday's Fed action. However, what we've seen is that over the last couple of years, the allocation that investors have had towards cash has risen dramatically. This is a time, I think, to revisit a longer-term strategic asset allocation and deploy that cash into your portfolio in a strategic manner. One thing that we're cautioning our clients with is, they're looking to replace that 5 to 5.5% that they were getting in the money market kind of area with something that's a similar type of yield. But today, you have to take more risk to achieve that. There's a lot of conversation about can high yield bonds make sense here as a replacement to the types of yields that we were getting in the money market space. That's a very different risk. There's credit risk there. And right now, that credit spread is just at 3% or so. Rewind the clock 2 years ago, back when some recessionary concerns were elevated in 2022, that spread was 6% or 600 basis points. And if we were to revisit that, that's a 10% downside to the high yield asset class if that were to happen. Very different return profile and volatility profile versus a money market which doesn't move in value. So that's a long-winded way of saying that your strategic asset allocation should not change just based on what the Fed does. And be wary of the risk that you take is when you take one money market kind of return stream and apply it to another thing like high yield.
Matt, while we have you, technology in past cutting cycles has outperformed. Is that anticipated to be one of the sectors or themes that continues to catch a bid from either the larger institutions or individual investors out there that are trying to pick and choose where they should continue to lean into themes that have done well over the past year, 18 months, or take chips off the table?
You know, right now we're talking about the current macroeconomic environment with our clients as being one in kind of later kind of cycle dynamics, meaning that in our view, the risk of a mild recession is still somewhat elevated. And in that sense, you want to embrace diversification, not just concentrate into what's working well. If the economy does achieve a soft landing, yeah, sure, technology could continue its current momentum, but it is a higher beta sector. And if you do start to see the economy continue to decelerate and the labor market continue to decelerate, there is the risk that that high beta kind of profile of technology can work against you. And so I would just caution a little bit against concentrating into one specific sector of the economy. Instead, embrace things like U.S. small cap, U.S. mid cap, international equities to get diversification, which is kind of the bedrock of a good portfolio.
Matt Stuckey, Northwestern Mutual Wealth Management Chief Portfolio Manager for Equities. Great to have you here with us on the show. Appreciate it, Matt. We're talking to personal finance experts from across Yahoo Finance all week. Today, we've got Tiffany Alashay, who is the host of the Money Glow Up podcast, to tell you how to build a bulletproof budget. But first, we're talking all things housing, breaking down how mortgage rates are moving and if you should think about refinancing your home. That's right after the break. The Fed cutting rates is welcome news if you're looking to take out a mortgage to buy a home. And to break down what you need to know about mortgage rates, we brought Yahoo Finance's very own Claire Boston here in studio with us. Claire, great to have you here.
Thanks so much for having me.
Absolutely. So let's talk about this. The Fed makes the decision to cut rates 50 basis points. But now what? What does that mean for potential home buyers that have been on the sidelines to this juncture?
Right. So right now we have mortgage rates at right around 6.2% for the 30-year fixed. We're looking for them to maybe fall a little bit more in the coming weeks. But the counterintuitive thing is that a lot of the Fed's move has already been priced in. Mortgage rates have been falling all summer. And as a result, that probably puts a ceiling on how much lower they're going to go. You know, we're probably looking for range-bound rates for the rest of this year.
Yeah, and so with that in mind, I mean, existing home sales, as we're continuing to track them, and some of the data that we've gotten over the course of this week with new permits, construction, how will this overall impact home affordability as well?
Yeah, so the issue is that overall homes are still very, very expensive in this country. And we didn't really see much buying over the summer. You know, when rates go lower, that does allow people to refinance. It allows people to have a lower monthly payment. But the really big issue is just that we are near all-time highs in housing prices. So, you know, maybe lower rates will bring more people off the sidelines this fall, but we still have a really big housing affordability issue in this country.
Affordability, and it also comes back out to build outs as well, the amount of construction that we're still anticipating to fill that gap. Also, Claire, thanks so much for taking the time here with us, joining us on set on Yahoo Finance. And also, while we're on the topic here, let's stay with mortgage rates. They have come down substantially in the last few months, and now that the Federal Reserve has cut interest rates by 50 basis points, those on the sidelines of the housing market are hoping that they drop even further. And homeowners who bought at 7 to 8% interest rates, they might be wondering if it's time to refinance for a lower monthly payment. Joining me now, we've got Nina Gidwani, who is the head of refinance and home equity over at Chase Home Lending. Great to have you here in studio with us. Thanks for joining for the conversation. So let's start there. Is now the time for people who are sitting on 7 and 8% rates to refinance now that we're starting to see a rate cutting cycle initiate?
Yes, absolutely. It's a good time for those customers to consider getting a lower rate. And so we see today if rates go down below 6%, about 4.7 million customers would become in the money for a refinance opportunity. And that's a significant amount of customers who may have bought a home in the last 2 or 3 years and are sitting on that higher rate, as you said, and could take advantage of a lower payment. And so at Chase, what we've done actually just last week for a limited time only is we've improved our refinance pricing nationally so that we're able to help customers really take advantage of this opportunity to get a lower payment or take cash out and consolidate some of their debt.
We often talk about this lock-in effect for people who had gotten pretty good rates and perhaps are well below that 7 to 8% rate. So at what point do you really think we will need to see rates trickle lower to really kind of break up that lock-in effect, or at least the mindset around it?
Yeah, I think today we see about 70% of mortgage debt outstanding is sitting at less than 4% rate. And so that lock-in effect you talk about is customers with a very low rate, maybe an ultra low rate, and they don't want to trade that rate in for something higher. As we've seen rates come down, just as we have in the last year, particularly the last few weeks, I think that those higher rates will converge down. Customers will start to be willing to purchase a home and be willing to take on a higher rate. And people have to move. They have to sell their home, and they have to do other things in their life. So I think it's a great time for customers to start to do that.
When you think about what's already priced into mortgage rates right now, I mean, how much of the rate cutting cycle is already priced into mortgage rates at this juncture?
It's a great question, and I think Claire also said the same thing earlier. Is when the Fed announced yesterday and they outlined their long-term strategy, it's interesting the mortgage market didn't display very much volatility. We see the mortgage market as fairly neutral, and so that tells us that in some ways some of this change is already priced in, as you said, to mortgage rates. But what I would say to consumers out there is that don't try to time the market. Don't try to, it's impossible to do that. It's very difficult to control that. What you can do is talk to a mortgage professional, and we have home lending advisors across the country at Chase who can help you figure out if now is the right time for you to consider taking advantage of the rates that are out there today.
I mean, the mortgage environment, it's a combination of several factors, but the thought process and consideration for buyers is existing home, new home build out. Are we seeing any major difference in the types of rates that people are getting based upon whether it's a new home that they're going in to purchase or an existing home, where they already know there might be a little bit more of the hidden costs that they have to take on too when they are purchasing?
Yeah, no, I think that, again, customers have a lot of options now that rates are coming down, and it really depends on what your circumstances are. I would say the most important thing to do is to get educated about the process, to get educated about those fees, to understand what the mortgage process entails, whether that means you're looking to buy a home or you're looking to refinance. Talk to a mortgage professional, understand what your options are, and really try to get educated about the process.
What do you think homeowners need to know about their home equity right now? Given we were just talking about home prices being at all-time highs, what do homeowners need to already know about what their equity and where that equity stands at?
It's a great question, Brad. And as you said, home prices have been elevated for some time. Customers have also been staying in their home for much longer. And so that means they are sitting on more equity. And with mortgage rates the lowest that they've been basically all year, it is a very good time for customers to consider taking that equity and getting a cash out, consolidating some of their higher interest debt, like their credit card or auto loan debt, reducing their overall credit profile. It is a very good time also for customers to think about getting a HELOC and using that home equity to their advantage.
Yes, absolutely. Home equity line of credit as well for all of those who are new to wealth here, as we've broken it down in the past. Nina, thank you so much for taking the time here, joining us here on set. Nina Gidwadi, who is the head of refinance and home equity at Chase Home Lending. Well, owning a home seems a bit out of reach for many Americans. Even with the Fed now cutting rates, many may not actually see an impact in mortgage rates, so it helps to know how much house you can actually afford before you start looking. Yahoo Finance's affordability calculator can help you do just that.
So how much house can you afford? Here's how to figure that out.
The really obvious factor that affects housing affordability is the home price itself. But there are two other factors that are really important for housing affordability. One is the mortgage rate. The other major factor is, of course, incomes. So those are the three legs of the housing affordability stool.
Of course, affordability is a quality of life calculation, so only you ultimately get to determine what works best for your monthly expenses and budget. But determining how much house you can actually afford starts with some basic details that will help you figure out what your biggest and most important monthly cost should reasonably be. A key first step is to plug the following into a housing affordability calculator. Your household gross income, that's your annual pre-tax income. Your debt, think monthly payments on loans and credit cards. The down payment, a percentage of the purchase price of the house paid up front. The loan term, the duration of the loan. Interest rates, interest paid during the loan term, which can vary based on credit score and market conditions. Mortgage insurance, protects lenders in case a borrower defaults. Property taxes, a variable cost paid to local governments based on the value of the home and the land it's on. And of course, closing costs. To start, identify your household's gross annual income and gather 3 months of bank statements to estimate your debt payments. Plug that into the calculator. For this example, let's use $100,000 as the gross annual household income, a bit more than the median, with monthly debt servicing payments of $500. Lenders assess the percentage of your monthly income that goes towards paying your debts, your debt-to-income ratio, to determine your financial health and ability to take on a mortgage.
A lot of people go with the 30% rule of thumb for the housing costs. That's keeping your housing costs to no more than 30% of your gross income. Anything in that range should be comfortable for most people. But like most rules of thumb, you should think about how it applies to you individually.
Thanks to our very own Rochelle Akufo for that breakdown. And you can learn more about calculating housing affordability on the Yahoo Finance homepage. Well, consumers under pressure may soon get some relief thanks to yesterday's interest rate cut from the Fed. The cut is expected to ease the cost of borrowing money for everyday Americans in the months ahead. With more, I'm joined by Rohit Chopra, who is the director of the Consumer Financial Protection Bureau. Great to have you here. I mean, you just got to take us inside of the walls of the CFPB. What was going on? Were you guys astir as we were in the newsroom here when we heard the 50 basis point cut?
Well, we know that consumers since 2022 have been paying billions and billions of dollars in more interest on credit cards, auto loans, and mortgages. And just like your last segment, for many of them, refinancing is going to be a way that they can really cut their costs. We're pretty laser focused on making sure that consumers and households actually benefit from this rather than just the wealthiest and the most powerful in the society getting the fruits of this rate cut. We really do think there's big opportunities here. We're going to be taking some actions to look at how to streamline the refinancing process, making it quicker so more borrowers can benefit. And of course, we're going to continue our serious focus on the role of junk fees that can block successful refinancing and make households deeper in debt.
You know, we're going to get to those junk fees in a hot second because we all have a bone to pick with that. But when you talk about the differences that households should see here, what are the areas where households would begin to see the earliest difference now that the Fed has started its rate cutting cycle?
Well, typically, large financial institutions are quick to hike rates when the Fed raises its target, but are often pretty slow when it comes to bringing those rates down. Our analysis of the big credit card issuers showed they jacked up interest rates way higher than the Fed raised their rates, even when you can control for other factors. I really worry that in the very short term, people are just going to see lower rates on their deposits, and it's going to take some real work to make sure they have savings on their credit cards, mortgages, and their auto loans. Of course, as you know, Brad, for the tens of millions of people with student loans, people taking out student loans right now for college, much of those are fixed rates. They're not going to see any benefits. So the answer to your question is really going to vary based on who and what product, but we're firing on all cylinders to find ways that more and more people can benefit.
You know, it's so interesting because you talk about some of the fees from banks, whether it be overdraft fees or account-specific fees as well. I wanted to ask you about consumers getting hit, specifically with overdraft fees that they never agreed to. How is the CFPB taking action there?
Well, overdraft fees used to be something that was really occasional and a convenience for the paper check era, when you used to put a paper check in the mail and maybe there was some timing difference based on when you deposited your paycheck and when your bills were getting cashed. But over time, it turned into a multi-billion-dollar bonanza for the nation's biggest banks. And we have found many instances, including by the likes of Wells Fargo, of serious overdraft problems, including hitting people with 3 or 4 overdraft fees when the consumer would reasonably expect 1. Our efforts have already wiped away billions of dollars of what I consider unearned profits. And we're taking further steps to make sure that, 1, consumers are actually opting into this. We issued some policies this week to make it clear you can't just opt some consumer into this without meaningfully getting their consent and having evidence for that. We've also proposed some new rules to make it easier for consumers to compare an overdraft loan with a credit card or other type of loan, because in many cases, it is way cheaper to use other forms of credit to meet a shortfall. So there's big reforms happening when it comes to junk fees. Our work has brought down tens of billions of dollars across products, credit cards, bank accounts, and more. And we've got even more to do.
With that in mind, what are some reasonable timelines that consumers should be keeping tabs on these efforts from the CFPB going towards and looking at some of the practices of banks? And how do you also kind of assess where there are perhaps some people out there that have looked at the fees that are assessed by banks and said, you know what, if that's what they're going to charge me for overdraft, then maybe I lead into that knowing when my bridge is going to come. You know, there's kind of the both sides, I guess, that you have to account for at the CFPB.
Well, I don't know. I think what we really want is competition.
Sure.
We want to see banks and others compete for people's business. And here's what's happening in the market, say on overdraft fees. We're seeing more and more banks offering grace periods, more of them advancing your paycheck for free a day or two before it officially hits direct deposit. That's kind of the market that's really competing on the merits, not setting up a scheme on the back end to reorder your payments to make that $3 coffee cost you $43. So we see big benefits, especially for those neighborhoods and cities where lots of people are living paycheck to paycheck. But you know, Brad, when it comes to fees, I really want to go back to what we talked about earlier and in your last segment about refinancing. You know, a lot of people missed out on previous refinancing cycles, and some of it is because the huge closing costs that people face. There are a lot of junk fees in that mortgage closing process, and that means that it can block people from getting those refinancing savings. We're looking at all sorts of fees, credit report and score fees, title insurance, and more. If we can really make sure that closing is simpler and cheaper, we're going to see a lot more mortgages get refinanced as rates go down.
Rohit, thank you so much for taking the time here with us today. Rohit Chopra, who is the Director of Consumer Financial Protection Bureau. Thanks so much for hopping on Yahoo Finance with us.
Thanks so much.
Got it. Coming up, everyone, what the Fed's easing cycle means for the labor market. And more than half of job seekers are using AI to help with their job search and maybe landing them the job. We have the tips to help you use it to your advantage as well. Much more on the other side of the break. You're watching Yahoo Finance.
This is Yahoo Finance Invest.
Please join me in welcoming Hans Vesper.
It's an honor to welcome Jeff Zucker. Kevin Mayer is here with us. Anthony Scaramucci, Meredith Whitney,
Lindsey Vaughn.
The Fed's 50 basis point rate cut signals its shifting focus to the labor market. Our Fed correspondent Jennifer Schonberger asked Fed Chair Jerome Powell about the changing stance.
I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage. So very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that.
And for more on the state of the labor market, I'm joined now by Indeed Hiring Lab Research Director Nick Bunker. Nick, thanks for joining us here on the program. Just want to get your reaction to what you heard from Fed Chair Jerome Powell there and the balance of inflation and the labor market right now, and how you would classify the labor market.
I think I'm broadly in agreement with what Chair Powell said yesterday. This is a labor market that's much cooler than what we saw 2 years ago. You can look at pretty much any indicator of the U.S. labor market right now, and it's either signaling a labor market that's about as hot as it was just before the pandemic or slightly cooler. So I think it's appropriate for the Fed to say inflation's trending towards 2%. It's time to make sure that we're setting policy to support the labor market we've got right now. The labor market's in a good spot. We just need to, policymakers need to make sure that they keep it in this position it's in right now. And the Fed cut that they did yesterday will help that.
Is there a mix or a checklist or even this cocktail of parameters that you would look to say that the labor market is no longer in good standing? And how do we make sure that we're avoiding some of those risks as well?
Yeah, sure. I think there's a whole bunch of indicators you can put in that portfolio of the labor market to understand where things are. One that Chair Powell mentioned in his answer to that question was the ratio of job openings to unemployed workers. Back in the spring of 22, it was at 2. And now we've got about 1.1. And that's actually a little bit below what we saw prior to the pandemic. You can also see this in the unemployment rate. It's higher than what we saw back before COVID. You can also see this in the rate at which people are voluntarily leaving their jobs. If you remember the conversation about the Great Resignation, there's far fewer people now leaving their job voluntarily than there were back in late 2021, in large part because there's just fewer options and opportunities for them to leave their old job and most likely go get a raise at a new position.
Nick, while we have you here, there is a wave of unemployed people who are actively looking for work, who are leaning into artificial intelligence. How do you see this being done well, and what are some of the tools that people who are looking to either level up or re-enter into the workforce or make a pivot, how can they leverage AI to their advantage from what you're seeing over at Indeed?
I think there's lots of opportunities to use AI, generative AI, as an assistant to help you in your job search. So one good example here is, if you do land an interview, you can use it as a assistant to help you prep. Prompt it to say, hey, I'm interviewing for this position. What are some examples of questions that you could be asked in that interview, and you could prepare that way. Another option there is helping you edit or refine your cover letter or resume. That's something that you can sort of feed it what you have right now, and it can give you tips or potential suggestions that can improve your resume and cover letter and help get the attention of a hiring manager or a recruiter.
And then additionally here, just some tips for navigating the labor market right now. I mean, even though there is still strength in the labor market, or at least normalization from what we're seeing, as some economists have classified it to us, there is still opportunity for those who have been impacted perhaps by restructuring or by reallocation of resources, where they could be looking at this in current situation and trying to figure out how they can navigate both staying employed and navigating unemployment as well here. So, what are some of the checklist items that people can keep in mind there?
Yeah, so as you said, I would characterize the U.S. labor market overall as rebalanced and in a good spot. But I think much like before the pandemic, there are some sectors that are much stronger than that, and there are some sectors that are weaker than that. So I think one thing that you can think about if you're looking for a job right now is to look towards the sectors or the types of jobs that are growing quickly right now. There are some fields out there where things are still, hiring at a decent pace. One of them is healthcare, and I think that's especially if you're early in career, that's one that you can shift towards, in part because this has got long-term potential as well. This is something the U.S. is increasingly spending money on. I think also, especially in the wake of, these AI tools, is maybe work on your soft skills. So your ability to sort of communicate person to person, and really focus on those, the skills that maybe AI can't replace because it's not a human. So I think there are some opportunities right now. You can see job postings on Indeed are still 12% above their pre-pandemic level. So I think it's just a matter of people finding the spots where there are more opportunities that fit their skills.
Nick Bunker, Indeed Hiring Lab Research Director, joining us here on Yahoo Finance. Thanks so much for the time, Nick.
Thanks for having me.
Certainly. Guys, coming up, it's day 4 of our investing theme week. We give you the 4th rule to build your wealth, featuring the host of Yahoo Finance's Money Glow Up podcast, Tiffany Alshey. That's coming up next. Yahoo Finance is taking it back to the fundamentals with our theme week, Investing 101, 5 rules to build wealth. Today, we give you the 4th rule, bulletproofing your budget. We have an expert here to give you actionable tips for building a smart budget that still allows room for a little fun. Joining me now, we've got Tiffany Alshey, who is the budgetnista that you may already know. She's also the host of the new Yahoo Finance podcast, Money Glow Up. Tiffany, great to see you. Thanks for hopping on. So, let's start with a situation a lot of young people are going through. Just out of college, just got their first job, saddled with thousands of dollars in student loan debt. How do they pay their debt, invest for the future, and still have money left over for a latte or perhaps some food away from home, a night at the bar? Just turn it up.
Well, Brad, it is possible, although maybe not as easy as it used to be. First things first, especially, you should know what is your actual take-home pay. Let's just say on average, you're making $60,000 a year, which is what the average American worker is making, give or take. Right? You want to know how much you're actually taking home. There's a great website called paycheckcity.com that you put in the state where you live, what your income is going to be for the year, your gross income. It will take all the state components out, all of your unemployment stuff, and it'll tell you what your take-home pay will be monthly, biweekly, or however often you get paid. So you actually know what your actual number is. Once you know what that number is, you can start to create a budget before you actually start working, ideally. If it was me, and it was me, I'd be looking for a roommate if I'm just graduating college, or if I'm super young, so that way I don't have to pay as much. The average rent is about $2,500 a month for a 2-bedroom. So maybe your piece would be just over $1,200. Splitting utilities, you're looking at maybe around $150 a month. Your cell phone around $70, groceries about $300. I did a little bit of the math to see, and this person making 60 could still put 5% away of their gross income toward retirement, because you want to start as soon as possible. And if you find a company that matches, the average company matches 4.5%. So you're getting close to that 10% or more ideal for setting away for retirement. You would still have about $200 a month left over to save, and even about $175 or so left a month to save, to set aside for something like your fund, FUND. So it is possible, but you have to really look at your budget, work the numbers, and then automate that thing so you don't have to think about it.
Tiffany, unforeseen circumstances can take place from time to time. So tell us how to budget for an emergency. What do we need to know there?
Well, one, you have to split it before you get it. So if you have a job, try not to have all your money land in one checking account. Ask HR payroll to split your money before you get your money, because you've done the math and maybe you see there's an extra $100 a month that you can put aside for emergencies. So that's one. Two, the best way to really circumvent emergencies that might cost more than what you have saved is you might have to swipe that credit card. It's not ideal, but you might. So if that's the case, you want to make sure you're already in good standing. You should know your credit before you need your credit. And so I'd be working on making sure I had a strong credit score. So if I had to lean on a credit card for a little while, I have the option to do so.
Now, when it comes to spending on fun, a lot of people tend to feel guilty about adding something the way they want into the budget, especially when they have debt. So on your new show, Money Glow Up, you actually spoke to a financial therapist and coach, Asia Evans, about this. Let's watch a clip of that.
It's really difficult to talk about money.
Yeah.
A lot of times people feel so much more comfortable talking about, anything under the sun, but talking about money can be really, really difficult to people. So what I like to do in the beginning, it's kind of like, hey, what's the crisis? What brought you in? Why was now a good time for you?
Okay.
And then figuring out what's going on.
Okay.
And for some people, that is us looking at their numbers because something is pressing. And for other people, it's like, okay, take me way back. Let's start at the beginning. Walk me through your money story.
Okay.
Walk me through how your parents talked about money, all the money experiences that we were just talking about and naming. That's what we're doing first. And then what I'm doing is picking out the patterns. What comes up for you? And then how does that intertwine with your mental health?
Okay.
So a lot of times we don't realize that, oh, I am spending this money because of my self-esteem. You're not thinking that. I'm thinking that.
Okay.
But you may not be thinking that. But you're like, oh, it's a new weekend, so I'm going to get this outfit. Oh, we're going somewhere different or on vacation. I need a new outfit. And I'm asking you, how come? What does it mean if you don't have that outfit? What does
Okay.
that bring up for you if you're not showing up looking dressed to the nines all the time? So it is a lot of questions and walking me through somebody's story to understand kind of what's been going on for them and how does their mental health, how they feel about themselves and their life experience impact their patterns with money.
Okay, so let's talk more about financial therapy. Just tell us more about it and how it should fit into someone's money journey.
So it might not be for everybody's money journey, although I feel like everybody needs a little therapy. And so what's so interesting about financial therapy, it's actually Asia is a licensed therapist that kind of has like a concentration in money, if you will, because so many of us are affected by the lack of money, too much, too little, how we grew up, how much we're making now. In financial therapy, if you find yourself stuck because money is holding you back from the life that you actually want to live, might be able to unlock why are you in this position and what can you do specifically from the therapy standpoint, but from the financial standpoint as well to move forward. So to me, if you're someone who struggled in that space, I didn't even know this existed. I probably would have tapped into Asia years ago. But to me, if you're someone who struggled specifically with your mental health because of your finances, then it might be a tool that you might want to tap into.
Tiffany, always a great pleasure to grab some of your time here with us. Everybody can continue to tune in, listen up to the Money Glow Up. Launching today, you can listen to Tiffany's very first episode on all streaming platforms, 12 p.m. Eastern Time. Today, she'll speak with financial therapist Asia Evans on all things budgeting and how to have a good relationship with money. Hearts. Tiffany's got some great guests lined up as well, including Cabral Miller, who is the head of business growth and operations at Elegant Eyes, Brandis Daniel, who is Harlem's Fashion Row and Icon 360 founder, plus No Madness Travel Tribe and TV founder, and Vivian Tu, your Rich BFF Media CEO. You do not want to miss those conversations. They're every Thursday, 12 p.m. Eastern Time. Coming up on the other side of the break, we're breaking down how you can maximize your nest egg. That's right after the break. When are you going to start withdrawing from your retirement account? There are risks here. Sequence risk is the danger that timing of withdrawals from a retirement account will damage the investor's overall return, according to Investopedia. Our next guest thinks sequence risk can be an opportunity. To discuss, we've got John Reckenthaler, who is the Morningstar Vice President of Research. John, great to have you here with us. All right, so take us into the thought process here. Why is it an opportunity?
Yes, well, sequence risk is normally considered to be a danger, as you talked about, because people talk about sequence risk in retirement. When you start retirement, if you start pulling out your money from the portfolio and you're withdrawing from your portfolio and you hit a bear market, you can enter into this vicious cycle where you're pulling out money as the portfolio is dropping, and you reach a point where the portfolio cannot really recover. If you continue pulling out that much money each year and withdrawing from a bear market that hits you early in retirement, your portfolio gets too low, you can't recover. Basically, you're taking the same amount of money out, but as a percentage of your portfolio, it's too high. Well, the reverse happens within a 401k plan. In a 401k plan, it's the big item is at the end of your working career. You have the most money in there, And that's when high returns can really help you. So it's really not sequence risk, it's sequence opportunity, I think is the way to phrase it. It doesn't matter so much for somebody who's young if they encounter a bear market. There's not much money in their 401k. It's the last 15 years, and they don't gain that much during a bull market, but the last 10 to 15 years, if the markets are strong, if the portfolio performs well, that's a great opportunity for people.
How do people need to also be taking into consideration that there could be a far different inflationary environment that we're in as you start sequencing or as you start pulling on that retirement account as well? Where does that kind of weigh into the decision making around this?
Well, you've touched on a good point, which is we don't know how the performance is going to be. For people within 401ks that they're going to profit, or their portfolios are going to be best if they perform well from ages 50 to 65 when they have the most money in their 401k. The best things that they can do are outside of the market environment. One is that's a great time to use catch-up contributions. Over the age of 50, you can put $7,500 per year extra in past the limits into a 401k. That's $7,500 more to put to work if the markets happen to be strong. That's each year. That's going to be a great opportunity, that's take advantage of the catch-up provision. And people, many people in that age group have spent their money. They've bought their house. They've maybe had their kids go through college, so they have the more money to invest than they did before. So that works out well. Another tip, of course, as always, is to watch costs. There's no reason in 401k plans these days. The cost competition is so high among the different providers of funds that you should have to pay. With a very large company, people are paying 0.25% per year for their funds on average, 25 basis points. If you're at a very large company and you're paying much more than that, you should talk to your HR group and say, why am I paying that much? For small companies, it can go up to 1%, but there's no reason to be paying over 1%. And the final thing, the final item is to consider owning more equities. Now that can go both ways, but there are some if you look at the target date funds that are out there for people who are 50 years old, some of them have equity positions as low as 40% of their assets. That strikes me as a bit low, missing an opportunity to participate in a potential up market for stocks. Again, I'm not talking 1 year, I'm looking out 10, 15, 20 years. The odds are pretty good for equities over that.
And so with all of this in mind, and we only have about 30, 45 seconds left here, but how applicable is this cross-generationally, looking at how different generations who are building up their retirement and trying to make sure that they have enough to get to and through retirement as well, are looking at when they should begin extracting from that?
Well, in terms of the generational question, the item that I've been talking about, the sequence risk, that is a little bit out of people's controls. It depends on when you start working, when you retire. As it turns out, people who are retiring now, say they're 65 years old, have had since 2008 for the last 16 years, or 2009, last 15 years, a wonderful bull market. It's been a wonderful opportunity for them. They picked a great time to be participating in their 401k plan. Whether that occurs over the next 15 years, we shall see.
All right, John Reckenthaler, who is the Morningstar Vice President of Research. John, great to have you here. Thanks for breaking this down for us. Appreciate it.
Thank you. Thanks for having me on. I know it's a busy day with the Fed cutting rates.
Busy week indeed.
Yes.
Thanks so much. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. You do not want to miss it.